Thank you guys for joining. We will start in 2 minutes. Let others join and we'll start. I hope guys you can hear me well.
Yes, sir.
Yes, sir.
Okay. And my screen is also visible to you, right?
Yes, sir.
Yeah.
Okay, guys, let's start it. Let people join, but due to the interest of time, I think we can get started. So thank you for joining today. Right, and today is our second session on FRM pre-read. Before we start, just wanted to understand, are there some people, those who are joining today first time or missed last session?
Yes, sir.
You are joining first time, Kusagra.
Yes, sir.
So what you can do in on your admin app, means on your learner apps, you can find the recording of the last session. Right. So guys, those who are joining first time, like this is a first session. So last Sunday we did introductory session. Right, in that I shared like couple of basic details only, like what is FRM, what is GARP, career opportunities, India economic detail, and then we start with the FRM pre-read and we covered a lot of topics. I think we covered till here last time, right?
Yes.
So can we first, so those who missed the session, you guys can, yeah, Abhishek, right? Today is your first class, not an issue. So in the first session last Sunday, we went through some basic details only. So those who missed first session, they can go through the, not an issue if you not watch any pre-learning. We are still going through pre-learning only. So I'll cover a lot of things and we will also do some revisions as well, what we covered last time and what we are going to do today, right? So not a problem. You can watch the recordings of the session maybe today, tomorrow, or next week at your convenient time. But do watch it. And I also uploaded the pre-reading learning material as well on Learner's app. So you can find it over there. And if you find any difficulty to access the material, then you can reach out to Zell admin team, right? So let's do some quick recap what we covered last time. And you can hear me well, right? Or can I be a little bit louder?
Yes, sir, your audio is fine.
My audio is fine, right? Okay, good. So quickly, like, what is risk? What we covered last time? What are the different points we covered under the risk? In brief, like suppose in one or two sentences you want to define a risk, what is that?
Probability or chance of losing money,
Okay,
or,
money
or
or
the
anything. Yeah, any
anything, a
unexpected thing.
deviation from the expected thing.
Okay, so happening of any expected or unexpected thing, right?
Yeah,
Which is undesirable, whether it's related to money or anything, right? But here, when we talk about risk in terms of FRM, we generally talk about money, right?
right.
Because so that is the thing. Okay. What are the different credit risk types? What are the types you covered? Credit risk type.
Default risk, downgrade risk, and credit spread risk, counterparty risk, concentration risk.
Okay, makes sense. Let me just quickly go through the risk we cover. Yeah. So as you mentioned, default risk, downgrade risk, credit spread risk, counterparty risk, and concentration risk. What is credit spread risk? What is this credit spread risk? Anyone?
Uh, that's the risk.
More the
Represent
risk,
the
more the reward.
Yes, Rudra, you repeat again, and Rajneet, you can, Ranjit, you can follow Rudra.
yeah, Rudra can.
Rudra, you can go ahead. I think we could not able to hear you. I think she's on mute. Yeah, Ranjit, you can share your views.
It represents the yield between uh, risk and risk-free financial instruments.
Okay.
Sir, risk
Risk.
uh, between any two types of bonds can be called credit spreads.
Okay. Yeah. Sorry. And before I continue, actually, one of the feedback what I got is during the last session, I think some of you are still undergrad. I can completely understand, right? You are still in the graduation, so some of these topics might be new for you, right? Or might be something which cannot be digested in one session, right? Completely understand. But understand, guys, these are just pre-learning topics. What we are doing today, we're going to do it again and again, right? So this would be a continuous process, but expect something you have to be prepared for if you are targeting your part one attempt this year, right? We are still covering some of the basic details, right? So if you find something which is something more complex or something which you are not aware of, right? So that's why I uploaded the material as well. So, and I also told you last session in that during last session as well, and I'm repeating it again today. If you find any difficulty, like couple of ones last session as well, they unmuted themselves and try to clear that out. Someone asked, what is covenant? What is model risk? Right? And I replied. So if you find any difficulty, if you want me to repeat anything again, not one time, two time, but till the time you could understand, you can ask. right? But expect something should be there in your exam. That things we covered last time, the things we are going to cover, right? So, and that's the reason I'm telling you this so that you can prepare yourself well, right? You can mentally prepare like what can be expected from you going forward, right? So we will go from basic to advanced, but uh, prepare yourself and go through the readings at your convenient time. But yeah, anytime, any difficulty to understand anything, please unmute yourself. Use your mic very well instead of chats as well. And someone posted in the chat like today is Abhishek's second session. We already had our first session last Sunday, right? But still we are in the pre-learning, right? Today and tomorrow we'll do that. We'll cover a lot of topics, some of the repetition, some of the more topics we'll cover,
Sir,
right? Yeah, Abhishek.
yeah, where do I learn these topics? Because I just paid my fees today.
Hmm.
This is my first class. I know nothing about these things.
No problem, Abhishek. That's why I told like those who are having the first session today, uh, consider this like we not covered lot of things so far. Like
Okay.
last time we covered till over here only, and we are going to repeat some of the topics again. Like we covered what is risk, type of risk. So we'll do some revision and then we will continue.
Where do
And
I get these topics so that I can revise?
yeah, so you can get on the Learners app.
Okay.
The access will be given to you. You can
Okay.
reach out to Zell admin team or send the message
Okay.
to the WhatsApp or maybe the mail ID communicated to you, and they will give you the access. In that, you can go through the 4 hours recording session as well as the material as well, right?
Okay.
I
Okay.
uploaded this material over there, so you can go through. In that, questions, means topic and explanation both are
Okay, sir.
there. Okay.
Okay, sir.
Yeah. So we were discussing credit spread risk, right? So credit spread is something like you move from default free or less risky instrument to some of the riskier instrument. And the more the risk, the more the credit spread, the more the risk is there, right? So when you move from government treasury or government bonds to AAA rated bond, so suppose government treasury will offer you 6% yield or 6% return because very low risk, very negligible default risk, right? When you move from this to this, then some credit spread will be added and like suppose 1%. So for that, you should be compensated for higher yield as the 7%. When you move from AAA to AA, suppose little bit risk added of default risk or credit spread risk is added, then you might be expecting some higher yield. Then again, some higher yield when you move from AAA to AA to B rated bond. So credit spread is something like the nature of investments, the nature of instrument when it's changed, when some risk added, then you should expect some higher yield than how it added, right? So maybe the type of companies which the bond has, type of financials, or their board management, or that is there, right? So this is something I just wanted to show you, right? And what is credit rating? Last time also we discussed. Let's discuss something on credit scoring model, credit ratings. What are the three main agencies in the world which provide credit rating?
Sir, Moody's,
Moody's,
Fitch,
S&P.
Right, S&P, Moody, and Fitch. This we discussed last time, right? I found one material which I was using for other session. So I thought just to show something to you. But yeah, they provide the ratings mostly on the bonds or debt instruments, right? And we also discuss individual bond ratings, issuer specific rating. We discussed the Apple's example last time, right? In this can both can be different. Yeah, but credit rating agencies should be independent, unbiased, and be professional while providing rating. They use different methodologies, like Moody's use this, S&P and Fitch use, I think, same, right? And there are two kinds of bond, investment grade and high yield bond. This we discuss. Okay, then what are the types of risk? What are the types of risk we discussed last time?
Credit risk, market risk, operational risk, liquidity risk, counterparty risk, and reputational or legal risk.
Yep. Thank you, Sailja, for your answer. So we covered these different types of risk, right? When we talk about the market risk in terms of stocks and bonds, suppose you are dealing with stocks and bonds. So what are the different market risk? What are the different terms you will deal with?
Name
Yes, go ahead.
interest rate risk and FX rate fluctuations, commodity price, equity price.
Yes. In terms of stocks, what is the market risk? What's the term we discussed last time?
Beta.
Equity.
Beta, right? What beta represents?
Volatility.
Volatility, right? Yes. So these are the things we discuss. Okay. Let's continue further, right? And what we did last time, I think we'll follow the same. Like we will take two interval or two breaks at a different interval, one at 4 o'clock and another one at 5:30, right? Let's start with VAR, value at risk. Any rough idea what is VAR? Why this term? Because this is something, and this is we are covering in the pre-read, but this would be we will discuss couple of times because this is something which is one of the main topics which are going to discuss even in the foundation of risk management as well. This is one of the topic which we are going to discuss. So this is going to be repeated again and again.
May I?
Right? Yes, look good.
So the invested value becoming zero. Like what's the risk of the invested value becoming zero? So like let's say $1 million has a 5% of VR of becoming zero. I think so.
Okay, makes sense.
Sir, value at risk can in I think is risk where uh, a particular time period, it can be a day or a month, in which our value, what is the possibility that our risk will be limited to that extent. For example, I think if 5% we have, one day VAR of a particular company can be equal to 2 million at 5% alpha.
Okay, okay. So in the simple term, if I tell you, so value at risk means your threshold, how much risk you can bear, right? 5%, 10%. Like suppose when you invest in a stock market, you know that can be the time, like suppose you invested 1 lakh in particular stock. Then what's the minimum loss threshold you can bear? After that, you will cut off your, means you will book the loss. You cannot go beyond. So that is a limit. As a finance risk manager, your job is to discuss this with the finance team, with the management, or with the investment for which you are managing, because your job is to minimizing the risk if possible, right? So there are 2-3 ways, like you can minimize, you can mitigate, or you can eliminate, omit. When we talk about VAR, in that we are dealing with the situation where omitting the risk is not an option, means eliminating risk is not an option, right? Because we are in the market in which some of the other risk would be there. Pratik, do you want to add something? Or I can mute you. Okay. So that is VAR, right? So let's discuss what this terminology is. Can I zoom this little bit, or is this fine for you guys?
It's fine. It's fine.
Good, sir.
Fine. Someone said zoom. Okay. Okay. So it's a statistical measure, right? You might have looked at this probability distribution. You might have studied during your maybe high school or graduation, right? This is a probability distribution, right? Bell curve, we can say this is the 5%, right? This is the 95%, right? So this is the statistical measure, first of all, which conveys to you the potential maximum loss or value of a portfolio over a given time period. Like I told you, maximum loss, like in that, my example, 1 lakh you invested, 10,000 is the maximum loss. You cannot go beyond to 10,000 unless and until is below 10,000, you are comfortable, right? And companies work in this way. Even not only companies, investments, those who hold the debt funds, mutual funds, right? They are responsible for their investors. They are liable for their, so responsible for to give them approximate return what they communicating, right? So sometimes they have to deal this kind of situation, if because when we invest, we don't know where the investment will go, will take to us. It can be higher side, sometimes it can be lower side as well, right? Till the time at higher side, we are okay with that. Sometimes some situation not go in our favor, then till what time we can stay with any particular investment if it's going against our expectation. So VAR is the great measure, right? In stocks, sometimes you get an option of stop loss limit, right? Like suppose you invested at 85 per stock, you put the stop loss as 75, right? So till the 75, you have the courage, you want to stay with the investment. After that, you don't want to bear that uncertainty, right? So you can also, not directly, but indirectly, you can relate to that. So it's a statistical measure which measure the maximum potential loss you can bear. In practical term, VAR answered the question, how bad could things get with a certain problem? How bad? How worst the situation you can able to bear it, right? For example, a bank, right? Generally, when banks is very conservative in terms of investment, they cannot go beyond the threshold sometime because they have to meet with the RBI guidelines as well in terms of investments. They have to show their investment products as well. So in that also they have to specify this kind of details. Suppose a bank might report that it's one day 95% VR is 5 million. Means in particular one day maximum they can go ahead. So 95 it's a confidential or you're confident like you loss will not happen. That's a 5% probability that may happen. This means that on 95% of the days, the portfolio is expected to lose not more than 5. right? And there is a 5% chance that loss will exceed the 5 million. So you 95% times you're confident. Like what's the threshold we put? 5 million, that will not cross. But there might be the situation 5% of time. Trump announced tariff, pandemic hit, right? Russia attack on Ukraine. In that, till the time you cover your position, you may exceed the 5 million. So that's a 5% chance of that, right? In other words, the 5 million is the threshold loss that only a 1 in a 20 days. 1 in a 20 days is how much? 5%. If you look at 20 days, so one day it may come that loss may exceed 5 days. Otherwise, 90 days, 19 days, it may be no loss, profit, no loss, 1 million, 2 million, 4.5 million, but will not cross 5 million in a single day. Where is or evaluate risk based on historical volatility and correlation of model distribution of return, right? Because you know that like how historically the any particular investment perform, right? And accordingly you try to assign the value. And this is just one example. Like historically, if the investment is more volatile, right, then you may have to like move your threshold like 5 to 10% also you may have to go ahead with. A simple example of calculation. Suppose a portfolio has an annual standard deviation. Standard deviation is risk, right? This is again the another terminology you might have studied during your graduation, high school, or maybe during your master's. And is roughly normally distributed like this. The 95% one day VR can be estimated at 1.65 standard deviation for that day, right? Don't go in more into terminology or calculation. This we are going to discuss again and again. Even in our foundation of risk, we have the entire discussion again, right? Okay, someone post. Okay, Karan, I think you posted. Okay, another one, another Karan, sir. And what if in total the loss go beyond 5 million? So that means, like what you are expecting, Karan, that there would be 5% chance, like that may cross, right? And that's a 95% of chance it will not cross. So that BAR will specify that. It doesn't mean like, see, you are just trying to put the threshold limit like this will not happen. But sometime it may happen. Till the time you act, you may incur a loss. Till the time to cover your position, because some of the positions like banks has a lot of investment in bonds or maybe stocks or some in liquid. Till the time to you try to unwind the position, you may hit threshold as well. But how to minimize? Sometimes this kind of calculation you have to do. And VAR is the one of the good measures uh, risk managers use. You will also use in the future, right? This statistical measure in terms of looking at a lot of data, a lot of historical studies you have to do, right? This example, I think we cannot discuss right now. We will discuss later on. So VAR is widely used for risk limits, limiting your risk, right? And this is, see, sometimes loss is something which no one want to do, right? Not on a personal level, as a firm level, because we hate losses. Everyone love profit, right? Till the time your position is in profit, you enjoy. Since you can see the red lines, I think you become uncomfortable. So how uncomfortable you can be? Because here you are not working on personal level, you have to work, you're working for someone else, right? So your job is to minimize the risk, minimize the loss. Can be so stop loss limit VR is the good measure, right? I think if I ask you, even I can also relate to myself. Sometime it may happen like we invested for some short-term profit, but when it converted to loss, we still sitting 5%. We are waiting to convert into profit, 10%, still waiting. Then it became 15, 20, 50% lost, and we are still sitting, and now we are thinking like, this is my long-term investment. How many it happened that with me? I think many times. I think I can relate with couple of you as well. But on a personal level, it's fine, right? It's our money. We can sit with 50% loss, but firm cannot be, right? For your job, firm, cut the loss, book the loss, go ahead with another investment and use that money, right? So to realizing that situation, working practically is very important, right? It's important to note that VAR doesn't indicate a magnitude of worst case losses beyond the threshold. It doesn't indicate that. As I think Karan asked, like what it will be go beyond. It may, right? In some situation, it may. So it doesn't indicate like your stop loss, you will stay over here. Sometimes it may cross, but what you want to act when that hit, that's the main situation, right? This we are going to discuss, but again, the same thing. VAR is a statistical measure that defines a particular level loss in terms of chances of occurrence. It's confidence level of the analysis, right? Same example, like suppose the 1 day VAR is 1 billion and 95% is the confidential. So 1 day VAR, so it's the 5% VAR. So that's a 5% probability, like in any particular day, loss may cross below or above 1 billion. Otherwise, it will 95% of time it will stay below. Right? Tail risk. What is tail risk? We will discuss later on. Any question, confusion in understanding VAR? Okay, what does the 1 day VAR mean? So generally what happens, banks or big investment bank, they particularly check their investment or their portfolio every day. That's particular investment in that because they invest billions of rupees. So for them, 1 day can be a game changer for them. So they check it every day. So 1 day VAR means in particular day. Suppose take an example, a bank, $20 million they have in particular investment. So they will check for a particular day. Suppose worst case scenario, Sensex down, inflation is high, recession 2-3% down. Where my portfolio is on that particular day. Is it hitting the threshold? 20 million, suppose 5%. What is the 5% of 20 million? 1 million, right? So whether my loss is above 1 million or so. If it is, what would be my action? Should I wind up the situation because now it hits the threshold, or is it below the threshold, and whether I'm comfortable or not? So that is the 1 day VAR. In particular, 1 day VAR, suppose 5%. So there are 5% chance like threshold will hit, or 95% of the time you think like it will not hit. So that is the 1 day VAR, and this we'll discuss again and again, Harshita. Right. This would be a regular discussion going forward when we go to foundation risk management. So this will be, we will discuss again and again. Next is expected shortfall, right? So expected shortfall is also known as the conditional VAR, or CVAR is a risk measure that complements VAR by answering that. What did answer conditional VAR? If things do go bad, like suppose your 5% threshold hit, 1 billion crossed. What is the average loss in the worst case day? Then what you will do? Conditional VAR means, will you change your threshold limit, or will you act upon it like covering loss, or like booking the loss? What's your situation? So in technical term, expected shortfall is the average loss given the loss beyond VAR limit. Let's take an example. If we take 95% of VAR, right, expected shortfall at 95% would be the average loss of worst case 5%. Suppose for a portfolio of 95% VAR is 10 million. 10 million is the portfolio. And when loss, for a portfolio, the 90% 5% VAR is 10 million. So 10 million is your threshold. And when loss exceeds 10 million, the average loss is 15 million. Then the 95% VAR expected shortfall is 15. Right. Another simple example, imagine the worst 5% of daily losses for a portfolio like 11%, 13%, 15, 20, 25 million. Then decide the tail loss beyond the VAR cutoff. The expected shortfall would be the average of those 5 loss figures, right? Like here, what would be the average over here? 45, 60, 73, 85. So it is around 17 million. So this is 17 million is the expected shortfall, which is okay, 16.8 million. Expect what is expected shortfall provide to you. So it provide information on tail risk that VAR omits. Some like in VAR is the limited situation, like 95% probability. 5% would be the chance it will cross 1 billion. But what happen if it cross? Right. So what will be the expected shortfall in particular time frame? So that also you have to calculate. You cannot just sit on, okay, we figure out 5% this and that. But suppose you not winded up the situation, you still continue expecting next day you will cover the loss, or it's not possible to because it's big investment, a lot of approvals required, or maybe management thinks, okay, it's a 1 day situation. Pandemic is there, we will bear the risk for 1 month, then we will continue. Then what would be the expected shortfall in your portfolio would be there, which VAR or VAR cannot be give the answer for. So what it captures? It captured the severity of extreme losses. In risk management, expected shortfall is considered a more coherent risk measure, and regulators like Basel for banks are moving towards using expected shortfall for determining capital. Right? Basel are for the banks, right? They continuously look at the bank's portfolio. They also segregate their portfolio in the level 1 asset, level 2 asset. Level 1 is the secured one, level 2 with some risk, level 3 is the more risk in that. So because banks assets is not bank's money, it's people's money. So bank cannot play on that, and regulatory measures like RBI and that they keep a close eye on that, where they are investing, what is the risk, what is the VAR, what is the expected. So this is very correct measure for the banks, RBIs, or maybe the central banks. They keep a close eye on that, and they use this as a correct measure for considering what can be the worst case scenario. Yeah, Karan, you can ask the question.
Thank you, sir. Sir, my question was, sir, how would this help? How would expected shortfall help a company to determine something
Yep.
like there is an just because there is an average, average comes out to 16.8 million, and the extreme loss is right now is 25. But just because it is an average, it might also cross 25 million as well. So how that
Yeah.
can help? How it will help a company?
So it help a company in a way. Suppose you took a bet like threshold cross, 5% cross, but you still invested in considering, because no one knows where the situation would be normal. When pandemic was there, no one knows. Even the world around the world, United Nations, India, US, UK, when this will stop, right? So for you to make a decision, like it can stop tomorrow and market rebound, and suppose you cut your position today, tomorrow might be your loss might have covered. But suppose that not happen tomorrow, the next day, the next day. Then when you look at how many days you stayed, even though the threshold crossed, what is the shortfall happened in the portfolio? Your 100 million became 16.8 million lower than 83 million around, right? Yeah, it can cross 25, but that's why bank try to check this as a measure, right? How much correct, right they are, how much wrong they are in their prediction. But yeah, again, the limits always bank keep, like expected shortfall is also one of the measure, right? That can help them to uh, measure the historical data. So in the future, they can act upon it when the same situation prevails, right? But yeah, they always, here we are talking about the banks, but yeah, many companies they bound with the regulatory requirement with the company's uh, policy, how much expected shortfall they can bear and how much they cannot, and accordingly they act upon it. Maybe it can help to make some reserve in advance to cover the loss. Yeah, they can, like uh, banks generally keep that thing, right? As I told you, it's not banks' money. They are investing to generate good returns, but sometimes situation may not in that favor. I hope the current this answer your question, and this we are going to discuss again and again. Don't worry, right?
Yes, sir. Thank you,
Expected
sir.
loss, yeah, and see these are the things you are going to deal with when you work, right? As a finance risk manager, your job is not just to identify the risk, minimizing the risk, but suppose you face any worst case scenario in which taking the decision is very hard, right? How much you can go wrong, how much less you can go wrong. But suppose many times market test you for many days, right? And when you reach your limit and when you think like cannot go beyond this, market rebounds, it may happen. Those who are trading, I think current, you can relate more. I think as you told your active traders, sometimes you take bets, you take positions, and market walk opposite. Then you unwind the or maybe cover your position, then it could differently. That happens, right? So that is the thing. So in the risk management, we have to think what is my limit, what is company's limit. A lot of discussion is required, lot of permutation combination is there, right? Because these are the statistical measure, so that we have to use. So in a summary, while value at risk give us the threshold will not exceed X percentage, suppose 5%, threshold is 1 million, right? Expected shortfall tells you on average how much you lose when that threshold is exceeded, right? And you can learn these terms 99% of time. Either of the term will be tested in your exam because these are the main terms you can expect in your exam. I would tell you. Maybe the calculation as well, right? When you go into calculations. So this makes expected shortfall particularly useful understanding the potential impact in stress market condition. We are not talking about the normal market condition. Normal market condition, everyone is a king, right? You bet on anything, you will not make profit, but at least not a severe loss, right? You may be the king when in the distress market condition, like what we have seen in the last month, when you are sitting at a very less loss or maybe under your threshold. That is the work you have to do. Any question, confusion before we move to the next point? Yeah, Karan, do you have anything? Okay, I think we'll over you, right?
Yes, sir.
Yeah, do you want to add
Sir,
something? Yeah.
yes, sir. Sir, in the previous question, sir, don't you think like 25 million was the extreme case? That would be a better measure for a company to control their finances than taking 16.8 million into account. Ma'am, sir, because 16.8 is just an average.
Yes. So again, can you please repeat the question, Karan?
In that question, in that example, sir, don't you think taking 25 million as your extreme loss, as a measure to take your extreme loss, will be better for a company than taking 16.8 million, because 16.8 million is just an average.
So extreme loss means in particular, suppose these are the 5 days count, right? So during that, which threshold crossed continuously, how much loss, extreme loss you generate. Like after, like suppose on 6th day, it may be 6 million you are green, then again 3 million. So these are the extreme situation in which continuously it happened. So that's why in the extreme shortfall, you take the average, like you take the bad, how much. So you just take the count in that. So that's why see 25 million is the particular one day, right? But it's not just one day it happened, it continuously happened when threshold cross. That's why we take the average, right? So particularly this is the correct thing because see taking the bet on one day, I think it's not ideal thing. You maybe go wrong in one day, but suppose you continuously took bet and it happens, it continuously hit the threshold. And what's the situation you faced, right? Okay. Probability of default. Any idea on this? Anyone want to share something on this? Any thoughts? What this term specify to you?
Means the
Sir,
chance of default
Chance of default. We can,
in
this chance of
like
default can be due to the credit risk or counterparty risk.
yeah, counterparty risk.
Credit risk maybe, right? Okay. Yeah, Karan, I think you also wanted to add something.
yeah, sir, I completely agree with the sir. As the name suggests, probability of a counterparty might not fulfill its obligations.
Okay. So now the question is, when that's a probability of default is there, then why someone lend you? It's better they will not lend you, right? But they still, because it's their business. Credit cards, loans, NBFC, banks, companies, these are their business. Chances are that 1 out of 100 may default, but who will? No one knows. When you do a business, when you have the receivables, 1 out of 100 customer may pay you late, but it doesn't mean you stop doing a business, right? The risk is there, but you are also there in the market to earn money and to bear that risk. But what's the probability? In terms of account receivable example, what companies do when they think like 1% chance customer will pay less amount, not full amount, or maybe not with the interest. What they keep as a default measure, what they keep on their books along with receivables.
Reserves.
Bad and doubtful debts.
Yeah. And their reserve known as a reserve for doubtful debts, or maybe the reserve for unpaid, or maybe whatever the receivables they could, like suppose let's take an example. Any company 100 million receivable is there for particular year, right? Looking to the history, 1% people they don't pay on time. Either they companies has to write off some of the amounts, right? Maybe litigation happen, maybe they have to like waive off their interest or some of the commissions or something. That's a 1% happened every year. So what they will do, 1 billion they will keep as a reserve for doubtful debts, loss, loan loss. In the general in the bank they do loan loss reserve, right? So probability of default is the likelihood that borrower counterparty will default, fail to meet its debt obligation within a given time horizon, right? Like here, why I took a 1 year example, because you will measure in terms of particular year. Banks will also measure in particular year. And when bank measures, or when NBFC banks or any credit institution, they also segregates, right? Loans means commercial loan, residential loan, vehicle loan, credit card side, and accordingly they will do the probability of default, right? Lot of number crunching, lot of historical data you have to look at to get this understanding, right? And accordingly you assign that. It is usually expressed as a percentage of over a over a period of 1 year, maybe 6 months, right? But that time period is also very important for you. Let's take an example. If a corporate bond has the probability of default of 5% per year, it means that 0.05% probability that the issuer will default on the bond within the next year, right? Probability of default is a key component in credit risk modeling, right? You always have to understand like what is the chance, and that's why, and how you can get the understanding by looking at the credit ratings, looking at the history of the company, whether they defaulted on the loans in the past or on their bonds in the past or not. Accordingly, you can assign the probability of default. Okay, when she asks like, so there is always some percentage kept as reserve. Not always, but many times. Like suppose as I told you, you segregated the loans, commercial loan, residential loan, vehicle loan. There is a credit cards holder. You notice like residential loan has zero default last 1 or 2 years. Commercial loan 1% around, credit card 0.5%, vehicle loans mostly. You have to just seize the vehicle. Then for the residential loan, you may not keep any probability default or maybe very negligible because you are taking a lot of cares and small loans are there, right? Home loans and something. So people don't defaulted for a particular area, right? So it not always, but most of the time, right? Okay. It's one of the factor used to calculate expected loss. Like what can be expected loss? Suppose default happens, right? Out of 100, suppose 1%, then what would be the expected loss? Banks estimate PD for each borrower using credit score models or based on credit. As I told you, bank will not look at as a wholesome game. They will look at for each and every types of loan, borrowers, geographical area, accordingly they have to assign. Right, because default happen, then as you know, bank's money is not their money, their people's money, or RBI may be giving them some waiver, something. So they have to be very cautious of that, right? And if they have, and many times suppose it may happen, banks take that risk. Like suppose, let's take an example, someone applied for a home loan, but that person is not working in corporate, is working in a factory, not receiving salaries in their bank account, not having the tax return he files. Do you think any bank will give loan, home loan? Government bank, mostly not, because these are their major requirements, right? But what do you think? Private banks, do private banks or cooperative bank give loans? And maybe housing finance, will they give loan to this person or no? Probability is less. Okay. Yeah, Pratik. Okay. Bank can give the loan, but what they will try to cover as a risk,
Collateral.
collateral they will take. Mortgage is there, right? But as I told you in the mortgage, what's the situation like in the future, the house price or the situation of the house, they could not able to cover even the principal. Yeah, what Harshita mentioned, that will be the case, high interest rate, right? Like recently, uh, my sister-in-law's brother, I'm giving the example, he is into that situation. So Axis Bank gave the loan with the 11% interest. I also took the home loan, same time, 8.6%. So bank took 2.5% higher to cover the risk, because ultimately banks also want to earn higher interest to get more revenue. So for that, they take the high interest. Many people, they give money on 1% interest as well, right? Why? Because no conditions, no paperwork. Banks at least do some paperwork, mortgage is there, but banks, people still do that. Why? To earn some extra money. They have money they want to give as a loan, but ask high return because of the risk. So when risk involved, you have to pay the price, right? That is the reason why on the bonds, comparing to government bonds yield is 6%. They pay 6% coupon, interest 7%. Why other NBFCs or private companies, when they issue bond, they have to pay 9 to 10%? Because of the risk. How can someone trust you to lend you the money? So for that trust factor, for that risk factor, you have to pay higher, right? So banks do it for, okay, can you please repeat why government banks would hesitate to give away loans in certain situation? Okay, because government banks, they have to take lot of approvals, lot of measures, right? They cannot, like, they have some strict RBI measures, like this documentation should be there. Otherwise, uh, they cannot take this much risk. Private banks sometimes has some leverage, some liberty. No doubt they are under the RBI norms. They can, uh, but they have kept some of the conditions open. Like if they meet this much requirement, they can give loans. Sometimes government bank don't want to take risks, so that's why they hesitate. But private banks, due to sometimes to earn some higher interest, they make, right. So this might be the simple answer I can give. Yeah, Vancy, you can ask your question. Hello, Vancy, we cannot hear you. You can, if there is any problem in the sound, then you can post your question in the chat if possible, Vancy. Okay, thank you. Can you summarize PD once? Yeah, we are discussing probability of default. Don't worry. I'm lowering your hands now. Okay. Okay. So for instance, historically BB rated bonds, BB rated companies might have an annual default probability of 0.2%. Right? BB rated means it will go very down. If you see, BB rated means very high credit risk, credit spread will high, and maybe they are offering the 9 to 10% yield. Why? Because the default rate historically was very high. Not high, but it's there comparing to the other AA, AAA, or government bonds, right? Where a B-rated junk company might have PD around 5% or higher. If a bank has 100 loans, each with the estimate PD of probability of default of 2%, and these loans are to different borrowers, normal situation, right? Different borrowers would be there. The banks might expect about 2 of those loans to default in a typical year on average. Right. A higher PD leads lender to charge higher interest to compensate for the this what I covered earlier, right? Higher probability of default, ready to pay higher amount from your pocket, higher interest.
So during pandemic, the PD might be very high, right? During COVID. So what measures does bank take to cover those risks?
So in the during COVID time, Vijay, RBI also, not only RBI but central banks around the world, they came up with the interest waiver situation, or maybe some of the cooling period, 6 month, 1 year. They can continue to just pay the interest so that they don't default on their loans, right? Otherwise, what happened? Like suppose restaurant, he took a loan of 30 lakhs,
Right.
but 1 year, no revenue. How can he pay EMI? So bank maybe reach out or may try to deal with the situation, and RBI also suggests like try to support in a way so that they don't default, and next year or maybe whenever they continue the business, they can resume their EMIs. Till the time they can just accumulate interest and pay after that if they are agree on that. So this how they try to restructure sometime cooling period. They try to manage this pandemic situation.
Okay.
Yeah.
Thank you.
Because pandemic kind of a situation that comes once in a century kind of thing, right? That not happens every decade or something. So that is also sometimes, and some industries which affected badly, the banks or maybe government, they try to take more corrective measures to deal than that situation, right?
Right.
Okay. Uh, Ashley says, like, sir, is it more easier to get loans in cooperative society than private banks? Yeah, but cooperative banks also may charge higher interest than private banks, like because the risk is there, so they may give you, but ready to pay higher interest. That is the only thing. So okay, so here the example which we are discussing, right? So suppose there's a 2% or 0.2% probability, or around B rated has a 5%. So suppose a bank has 100 loans, each with an estimated PD of 2%, then they expect 2 of 100 loans may default. And what they do for that, what they keep on their books, what the term known as for the banks, along with loans, what they put it as per the RBI guidelines.
They provision extra buffer amount, which
Yeah,
is
that is known as the loan loss reserve,
no, right.
right? Bad debts or loan loss reserve. Like uh, default
Credit
not happen. Yeah,
credit
default.
debit fees.
Yeah, default not happen, but it may happen. For that, we already kept the reserve, right? And as per that's the RBI guideline. Banks strictly follow that. Not only banks, all the credit institution, not
So
only in India.
what is ideal benchmark for PD percentage?
That depends, Vijay. Suppose, as I told you, like historically, suppose for any particular bank, uh, they residential loans in a particular, suppose Mumbai region for the
Hmm.
Axis Bank. That's a chance they have to seize the mortgage property or default happen around 1%. So 1 out of 100 borrowers default, right? And suppose
Hmm.
on your books on residential loans, you have given suppose 300 crore loans in Mumbai region. 1% chance of, so you will keep 3 crore as a loan loss reserve. So your 1% will be probability of default,
Okay,
right?
understood.
So you take historical measures, maybe RBI norms or something, but yeah, not history is always the best teacher in this situation, right?
So basically, who decides probability of default (PD)? These are the risk managers, or how it is going to be
Yeah,
decided?
good question, Tanvi. So risk managers do all the study, all the calculation work. So you work as an advisor.
Suppose a new bank is started, like some small finance banks are there, and they wanted to introduce some loan in a particular region. How they will manage these things, because they don't have the data. They just
Hmm.
start this
So
particular
in
things.
that, so in that situation, Tanvir, what they do, suppose let's take an example, Jana Small Finance Bank, right?
Mhm.
So suppose they already listed, they are into history for many years. But suppose when they start giving up the loans, so they don't have any data, right? So they will
Mhm.
look at other peers, right?
Okay.
What are the other small finance bank operating in the particular region?
Okay.
They will talk with them. RBI also try to connect with their people, like let's study their data. They may not give you the all the confidential information, but some idea, like from last particular years, what's the situation, how we are handling it, how
Okay.
they, right?
Okay.
And
Okay.
good question, I think, because see, there are chances like after FRM or maybe right now, many of you are also working, some of you in the banks, then you may use this information, you may switch to the roles, and you may have to handle these situations. So know these kind of details is very important, right? So yeah, thank you. When
So
see,
sometimes banks do, like there is a some kind of arrangement, like we can say bank outsource these data from third party. Third party is there for all these things, where risk manager and every things are in place, and they just take the help from third party. Is it possibly possible?
yeah, if they don't have the any particular division of the, generally they do have, because
Oh,
RBI has the mandatory requirement, like they
okay.
have to appoint professionals, experts, uh, and those who have good credential, they can have the knowledge, can guide them. But if they don't have, generally cooperative banks, they do generally outsource some small credit companies, right?
Okay.
So they, but generally, if any particular established credit companies, whether it's a bank, NBFC, small finance bank, but they have to follow the RBI norms in that, right?
Okay.
Hmm.
Thanks.
When C as the question, would increase in coupon percentage be any value as compared to defaulting the whole notional, which is high? Okay, good question, Vancy. So here it's up to you. I gave you one example, right? Some people, they give the loans or maybe lend the money on 1%, like monthly I will take 1% interest from. There are chances like your principal might be at risk. That person may run away, though you know that person for 10 years, 15 years. Why you give that? Because you are keen to earn 1% interest every month, 12% interest, which sometime bonds, bank FDs cannot give you, right? So why? So your question is why you would invest in 9 to 10% of coupon, 9 to 10% of higher interest when there is a chance of default, right?
Yep.
Because there is a chance, may happen, may not happen, right? As I told you earlier as well, when bank know 2 out of 100 may default, but they don't stop their business, they do that. When we know that 1 out of 100 customers sometime might not pay, sometime half pay, but still they do the business. The same way, we invest for returns. In the stocks, what we do, we know that probability is there, situation may go wrong, but we are more optimistic, right? We work on probabilities, right? So how can we earn good return with the minimizing risk? So that's we try to do. Risk would be there, but it doesn't mean like we cannot invest like that kind of situation. I hope this answers your question, Nancy.
Yes. Can you hear me now?
Yeah, I can hear you now.
Yeah, okay. That answers my question, but I still feel that, losing a such nominal amount would be a more loss, right? How are we then going to encounter the probability of default of that amount?
Yeah. So in that situation, you have to like sit with the management. Like suppose you're working with the bank, so bank management experts, like what's their VAR, how much they cannot cross the limit. Because suppose you propose them like fantastic return is there historically no default, but there are some chances. Then taking the VR measure, extreme loss measure, you can deal in this kind of situation, right? So that is there. Like suppose let's take an IPO example, right? In the good IPO came, I'm talking about personal level. You have the gut feeling like I can at least earn on listing gain 5-10%. But suppose worst case scenario may be there, 5-10% maybe negative 5-10%. But are you ready with that as well or not? So it's up to you, it's up to firm. How can they willing to go wrong but less wrong? So that is the
Okay.
situation you have to deal, right? Let's take an example, Shark Tank. In Shark Tank, or maybe the VC, angel investor, they know that 2 out of 10 startups may close next year in which they are funding, but they don't know which those two would be. 2 out of 10, other 2 out of 10 may give them 3x, 5x return. So they take bets like let's take bet on this 10. Two may default, but any particular two may give me 2x, 3x, 5x, 10x, 20x return, which can cover the losses of other investment as well. So this how in investments other things works. No, in the banks or all the at across all the levels, high risk instrument to low risk instruments,
Okay.
right? Yeah. The reason to give you the example of VCs and that as well, because in the risk management side, sometimes VC angel investor, they also keep risk management professionals to guide them, which startups, which are the industries looks attractive, in which very high risk is there, which are very low growth industry, right? Like you have seen in the Shark Tank, someone came with an example of book publishing. Someone came with an example of any industry which is not growing but dying, right? So, suppose you are working for them, then you can collect the data, you can show the details like these are the probability, like their investment may not return you what you're expecting. So, you can guide them that kind of thing. And things are changing in India. I have seen many private equity companies, many venture capitals, angel investors, they hire professionals those they can guide on their investments to reduce the risk, right? And increasing the return probabilities. Okay, this we discuss. Like ensuring accuracy in PD estimation is important, right? And this is the job of yours. We can ensure that uh, you will be less wrong. Okay, let's take an example. Suppose you kept 1% reserve, 3 crore out of 300 crore loan. It may be that just 0.5% happen. 1.5 crore. Is this something bad? No, because you estimated high loss. Loss happened lower than that. You just kept the reserve. It's your money. You just kept it, right? You can reverse it next time. But suppose you estimated 1%, 3% happened. Your reserve is just for 3 crore, but it actually happened 9 crore this year, right? So here you have to work on that side. That someone may, as I told you, we can go wrong, but how much less? That is yours. 3 crore to 3.2 crore, fine, nearby, but 3 crore to 9 crore, 1% to 3%, it means you just misjudge the PD or probability of default. So accuracy is very because banks is also answerable to RBI, central government, and to other counterparties as well, right? Because banks and BFCs, and that when some fraud or default or any party do the frauds with this institution, then trust breaks, right? And a lot of questions arise when it happens with the Vijay Mallya, SBI, and that lot of inquiries that happen, like who gave the permission, approvals, this and that, Nirav Modi with PNB and other consortium banks. Then a lot of question arise, a lot of regulatory reforms then come into picture. Okay. Underestimating PD can lead to insufficient provision, right? And overestimated might result in unnecessary high loan principal or credit denial. Sometimes it may happen like you are too rigid, right, to give loans. Like someone asked, like why government hesitate, right? So it may happen like maybe unnecessary your you have money deposits you can give to loan, but you are not giving because you are very strict in your measures, which are not that necessary. So to balancing it out, not underestimating, not over, like this I told you, 3 to 3.2 crore, fine. 3 to 9 crore, 3 to 0 or 0.5 crore, maybe not a good thing in terms of business side. Okay, Karan has the question, sir, but if we can reserve on higher end, then we will miss the opportunity to earn that. Yeah, the same thing. Like you can miss the chances to earn good return if you are over cautious, right? So it's not to be under cautious, over cautious, is to have to balance. And how you can learn it? You can learn it over the period of time, the experience, right? With the data, with history, with the study, right? How to go wrong, but less wrong, right? Okay, I think we can take break in next 10 minutes. Let's discuss exposure to default. Then we can move ahead, right? Okay. Is the total value that lender is exposed to when borrower defaults. Exposure to default means suppose I taken the 50 lakhs loan, right? 2-3 EMIs I paid. Then I just raise my hand like I don't have money. I lost my job. You can siege my house, right? Do whatever you want, but I cannot. So how much is the exposure to default means when borrower defaults, and in other words, the amount outstanding that is as risk the moment of default. Like suppose out of 50 lakhs, I just paid 2 lakh principal. Last 1.5 year, 48 lakhs still outstanding, and I defaulted. Right, so 48 lakh is the exposure to default. Okay, simple. Basically, the remaining loan balance when the borrower defaults. What the example I gave you over here. Example is given 50,000, paid down 25,000 left. In credit card, what happened? A credit lines product, EAD can include the currently drawn amount plus any further amount the borrower could draw before default. Suppose you have the overdraft facility, you use it for your business, 2 crore, but some fraud happened with you, or you have to shut down the business, you filed the bankruptcy, right? The 2 crore outstanding would be your exposure to default. Banks often estimate a credit conversion factor for undrawn portion, right? EAD, exposure to default or exposure at default, is the critical component of credit risk calculation, along with probability of default or loss given default. Some terms are very related, but just a little bit difference is there, and we will discuss this again and again. Don't worry, in the foundation of risk management as well as in the further topics, because there are chances you will be tested on these topics in terms of the meaning or in terms of example given to you. Then you have to identify whether this you can identify as a probability of default or exposure at default, right? It determines the expected loss. For an example, consider a bank that expects if a certain corporate client defaults, expecting the client would have an outstanding balance of around 1 billion. So 1 million is the exposure to default. Like suppose you know that like in the history, you know, like someone took the loan, they pay for 8 years, 2 years left out, and they did something it not went well. 2 out of 100 loans happen in every 5 years. So there's whatever the amount left out, that is your exposure to default. Another example, if a probability of default is 2% and the loss given default say 50%, then expected loss can be PD into loss given default into exposure at default, so 10,000. Let's take an example. 1 million is the loan outstanding. Probability of default is 2%, right? And exposure, your exposure to default, like 1 million you gave. Now you already at risk because someone can default. How much? We have the probability of 2%, right? Loss given default means suppose default happen, then how much will be the loss? That is the 50%. 50% is the chance like you lost the money outstanding, right? And exposure, your how much exposure is the bank has 10 million. So your expected loss would be $10,000. Managing EAD involve credit limits or covenant to prevent borrowers from running up very large exposure right before default. Credit limit means you cannot, banks will not give, like suppose they give the 2 crore loan, then that's a credit limit, but they will take the, suppose it's a manufacturer, then they will take inventory as a collateral, or maybe they will not expose to too much risk, or maybe covenant as well they apply. We discussed covenant last time, right? What is covenant?
Conditions or restrictions.
Conditions or restrictions, right?
Sir,
Right.
can we take another example for it to understand it better?
Yeah, we will take it. Right. So they put conditions, covenants, credit limit, so that exposure at default can be minimized. Right. Let's take an example. So first take the summary. In a summary, exposure at default is how much money is on the line if default occurs. Right. Let's take another example. Okay, first I think someone asked what is the loss given default. Let me search. I think we already covered that. We have after this, so we will discuss that. Loss given default, right? So let's take an example. Someone lend you 50 lakhs as a home loan, right? Bank has the probability 2 out of 100 residential borrower defaults. Not fully, but it's some principle. How much? Let's say 30% loss happen when they default. So 2%. So this is your EAD. Exposure at default is what? This, like what we have over here. Right? EAD is 10 million, 1 million, right? Loan outstanding, you have the 1 million, right? So EAD is 50 lakhs. 2% is your PD, probability of default. And that's a 30% chance. Like you will not default entirely, but 30% will be the loss given default, or LGD would be there. Then your loss would be, expected loss might be 50 lakhs into 2% into 30%. Can someone calculate this for me? For this example, what would be the expected loss?
It's a 30 lakhs.
No,
30,
this is
30,000, no?
30,000. Yeah. So it would be 30,000.
30,000 is
30,000, sir. 30,000.
30,000, right? Because so
So, sir,
chances, yes.
one question is there. See, exposures to default will come into the picture once the loan is given to the
Given to
borrower.
you.
Given to you, no? Not
Yeah.
before that.
No.
Okay. So
Once someone,
there is
yeah,
a
once someone lend you money,
okay.
when bank lend you money, bank is at risk of exposure at default. How much? The money they give you. You may not default on entirely, but in this example, chances are there 30,000 bank may expect expected loss. Average scenario, not that not come with you, but maybe with someone else. Not 30,000, maybe 5,000 from here, 5,000. But overall, when
Overall,
bank's 50 lakhs is at risk or it's
Mhm.
outstanding, 30,000 may loss may happen.
Bank
It,
start calculating exposure to default once one
they lend you.
particular borrower start defaulting, or when it is a
No,
overall
once
one.
they, no, so they expect once they land.
Okay, once they lend, then they expect that much of loss can be there.
Yeah.
Okay. Got
And
it.
accordingly, they calculate expected loss. Accordingly, they keep the loan loss reserve, right? Probability, that everything. Okay,
Got
so
it.
we can calculate.
So one question, like a bank has lent 50 lakh rupees, and on that they are only have a probability of losing 30K amount.
Yeah, average.
Okay, so it's
But
including
isn't
all
that
the
too
loans.
less?
Yeah, that's what.
Sorry.
Isn't it too less? 50 lakh versus 30K.
So it may happen like once you borrow on the next year, or maybe after, suppose you took the loan of 25 years, right? You may continue. So it's an average scenario. So this how bank calculate. Like suppose here at not 50 like suppose I do over here 500 crore, then you will find some higher amount. So
So it
this
depends
how
on
bank
history, right?
this how bank calculates. Like first they use what would be the probability of default. So this we understood over here, right? Another take the measure if that happened default, then what will be the loss given default? Like suppose default happened, but how much loss can be generated through that default? Like, and why someone asked the question like, is a D2 less? Because bank has the mortgage, they have the property, right? So they can sold and they can recover the money, but if the default happen, then 30% chances are there they cannot recover fully. That's why you can see over here less amount. When bank give you the loan, 50 lakhs, they have your property, na?
Yeah.
Right? So they can recover loss. But
So you mean
they can
collateral?
recover money. Yeah, they have collateral, they can recover, but it may happen like bank could not recover it fully. Maybe some bank charges, some this and that, auction cost, something. So overall 30K loss may happen. Right?
Sir, if collateral is less than this default happened, 30K.
No. Collateral, like suppose, let's take an example. Suppose I took a loan of 28 lakhs, right? And my property value, which I quoted in the stamp duty, is around 1.25 crore, right? So when I apply for loan, bank took my house on mortgage, right? If something happened, they can recover the money. So they have maybe equal or higher amount as a collateral with them. But while recovering, while selling the house, paying to them and giving back to me the remaining principal, that is something like some loss happened maybe in terms of charges, maybe they could not able to recover fully, right? In the future when default happen, 1.25 crore property value may give them less amount. So that may be the situation, maybe auction charge, maybe some other charge. So out of 50 lakhs, this how they calculate,
Okay, sir.
right? Yeah, but otherwise bank will always keep equal or higher collateral what they lend you, right?
Okay, sir.
Okay. LGD is like net loss. We will discuss later on, Suyesh, in some time. We can take quick break, right?
Sir,
I am not,
here EAD is 30%, right? In this
yeah,
example.
yeah. Yeah. In this example, loss given default is 30%. Okay, Harshita has the question. I'm not able to relate all these terms in one example together. I can understand Harshita because these terms are looks very similar, right? Probability of default. Now, what is loss given default, right? Then what is EAD? So we will discuss again when we'll discuss loss given default after a 5 minutes break, right? I'll try to simplify as much as possible, right? So guys, let's take a 5 minutes break and we'll meet after 5 minutes.
Okay.
Guys, can we continue now? Yeah, Nadia, we will cover that. Don't worry. How is exposure? Okay, EAD calculated. So EAD is your nothing but how much amount is outstanding, right? Exposure at default means how much it's still pending. Like suppose out of 50 lakhs, 25 lakh is outstanding. So it's a how much your money is exposure to default, how much is left to recover, means someone is left to pay you. Like as a bank,
So
suppose.
these terms are almost same. That probability of default is also like that. The money that we have not paid.
No, money is not that paid. Probability, okay, I'll explain that again once. I think once we'll discuss loss given default, that I think will clear some things. Yeah, but that is the only thing FRM may test on you. They give you a situation, this example. They may try to ask you like what is 2% maybe, what is 30% maybe, and then you have to ask 2% here is considered as a probability of default. Like default tempting chances are 2%, 30% is the chance like uh, money cannot be recovered. Then what is this 2% represent, like that way, right? So they have this option to test you on this, and we will discuss this again and again. Don't worry, right? So it will, and I'll also ask you the question in the same way, right? Uh, aren't EAD and expected loss both just estimation? No, EAD is not an estimation. EAD is the set thing. Like suppose whatever the amount outstanding, bank already know. So that is not estimation. That is the uh, bank still has to record. So how much is my money is exposure to default? How much still the outstanding money? So that is the fact thing. Banks know. Probability of default is the estimation. Loss given default can be the estimation. But EAD, and this can be also the question. Someone asks like question can be framed on this. Was the question you asked, right? Out of this three term, which is the most certain thing for bank to know? EAD, exposure at default, because this amount is how much outstanding is there. I hope this answered the question, Harshita.
So, didn't you say that EAT is calculated at the time of giving away the loans? So, at that time, how
No,
will you estimate or know कि कितना amount, sorry, how much amount will be outstanding?
no. So EAD would be like how much money is still outstanding. So you calculate expected loss. So this calculation is of expected loss, not exposure. Exposure as default is used to calculate expected loss. So EAD is uh, suppose this if a borrower originally took 50,000, he has paid 25,000 at the time of default. The lender's exposure at default is 25. So how much is outstanding? Right. So EAD is the entire loan granted to borrower. Yeah, not yeah. How much is outstanding? Like in this example, granted is 50,000, but he already paid 25,000. So how much is my outstanding? How much is that exposure to default? So 25,000, whatever is left to pay to me as a principal. I hope this answers the question to Abhishek and Ishita, right? Or Harshita, maybe. Okay, the question to Ananya, how is EAD calculated? So EAD, I think it's not need to calculate. They have to, uh, that's given how much is the outstanding. Another factor, LGD and PD, they use that. Yeah, so EAD is dynamic, every payment is changed. Yeah. When 50,000 is granted until the first EMI is paid, it will be the EAD, right? Yeah. Suppose 50,000 is or 50 lakh is the loan. So export as a default from the day one is your entire outstanding amount. Once you start repaying, your exposure at default reduce to the outstanding amount. Suppose for me, 28 lakhs loan is there. 1 lakh I paid. So right now, bank is exposure at default with me, sir, 27 lakh, right? Now let's discuss the loss given default.
So this expected loss is only calculated during default or like
Now in advance,
in
banks do,
advance?
like suppose default happens. Suppose this will be the chance we will not recover 30%. How
Okay.
much would be
So
the expected?
gradually, as the time goes, then this percentage keep coming down, right?
Yeah, it will come down because your exposure at default come down. Like today, 50 lakh loan. After 5 years, this may be 30 lakhs. So
Right.
your expected loss will come up, right?
So
But
how expected loan can be calculated in advance since EAD is just the outstanding amount?
yeah, EAD is the outstanding amount, right? So
But the formula that we are using here, how can we calculate this expected loss?
so 50 lakh, you have given to someone as a loan, right? 2% is the chance. Looking to the history, 2 out of 100 default. When they default in the history, what you have seen in particular area, how much that you could not able to recover fully. So that's a 30% chance. So you calculate in this. Sorry, exposure at default into probability of default into how much you could not able to recover in that, right? And don't worry, uh, this we discuss again and again terminology, and I'll also ask you the questions. You can reply accordingly. I
So,
think we can,
so,
yeah,
so isn't EAD also a historical figure? Like it
no.
might be the outstanding amount that has been left before.
Uh, EAD, I don't say it's a historical, but EAD is the actual loan outstanding with the banks, and PD and LGD or loan given default can be based on historical estimation.
Sir, my question is also same. I don't get the answer. That says exposure of default EAD, sir.
Hmm.
Sir, my voice is coming.
Yeah, yes,
Sir,
Ishita.
EAD is a outstanding amount. So how we calculate earlier?
Yes, exactly. That's my point.
What we calculated earlier, what like here, this example,
Yes, sir. Yes, sir. Sir, you have said that EAD is an outstanding amount that we have not given. So that how you can calculate the expected loss earlier?
uh, so okay. So let's say in this example, 50,000 loan is there, 25,000 paid, 20,000 still outstanding. So banks calculate. So you cannot default on 50,000 entirely because 25,000 already paid. You may default on the remaining amount, right?
Yes.
How much is the chance you may default on remaining amount? So historically, we have seen 2% chance. Okay, happen, default happen, right? How much is the chance like loss given default, like how much we could not able to recover? So 30% is the chance. Uh, loss given, like loss happened to us because we could not able to recover fully, or maybe some damage is there, some extra charges. So we may incur 30 kilo. So this is the estimation on your outstanding amount, whatever left. So EAD is the outstanding with banks. Probability of default. So default may happen. That's a probability based on historical estimates. And if default happens, then what will be your loss given if default happens, like how much loss bank may incur,
Okay.
right?
So
Now
this is
what
a
is the,
historical data, right?
yeah, historic.
Okay, so
Let's discuss what is loss given default. So you will get more understanding now. So loss given default is the proportion of the exposure that is lost by the lender when a default occurs after accounting for any recoveries. Like suppose 25,000 is outstanding, right? Historically, I've seen like 10% loss happened due to any charges where I could not able to recover fully, or through the after selling collateral as well, right? So 10% is the loss given default. So I could able to recover 90%, but 10% something bank has to incur as a loss. So if it is often expressed as a percentage of exposure to default, like essentially if a borrower defaults, loss given default answer, suppose default happens, what fraction of the exposure will lender not get back? Formally, LGD, loss given default, is 1 minus recovery. Suppose recovery rate over here is 90%. 90% you can recover, 10% chance you could, right? For an example, if a bank lends 1 lakh and the borrower defaults, suppose it defaults, the bank has the collateral, they can recover, but what happens? Bank managed to recover just 30,000. Perhaps by selling collateral or through bankruptcy proceeding, whatever they can do. Then the loss given default is 70,000. This is the extreme case. This is generally not happen. Otherwise, bank will go out of the business, right? If the loss given default is 70, but generally it's very less. This is just an example. In that case, the recovery rate was 30%, loss given default was 70%, right? Often certain type of loans have typically loss given default range, right? A well collateralized mortgage might have a low, like good collateral, high quality, and loss given default maybe less, like say 20% of housing assets cover most of the loan, right? Whereas unsecured credit card loans have no collateral. If you default, there are 90% of the chance you have to book the loss, right? That may be very little liquid. LGD along with, now the question which you have this with terminology, how you can use loss given default along with probability of default and exposure default is used to calculate expected loss and economic capital for credit risk. Lenders work to reduce LGD by securing collateral, guarantees, or other credit enhancements. Continuing the earlier example, let's stick with the example. If a 100K loan had a house or a car as a collateral, maybe bank could able to recover just 70K rather than 30K, thus the lowering LGD to 30%, right? In summary, loss given default measure how severe a loss will if default happen. Now the question may ask, FRM may frame a question like LGD is condition on what, right? Then what would be your answer? Loss given default is condition on what?
So please repeat the question again.
Yeah. Okay, let me raise a poll over here if possible. Okay, and you can give the answer, right? Can I raise a poll? If it's possible, let me try.
Yes, sir.
Loss given default is condition on which, condition on what, right? So option 1, let me say the multiple choice question. So choice 1 is exposure at default. Choice 2 is default happens. But third is no collateral. Let me just save the question and can I send you Okay, I'm launching it. Let me see if we can able to see. Can you see the poll on your screen?
Yes.
Okay.
Yes, sir.
Just answer it and I'll end it in 10, 20 seconds maybe. Ten seconds to go. Just 10 members left to vote if you can. Okay, I'm ending the poll now. Let me share the results with you. Can you able to see the result on your screen?
Yes, sir.
Yes, sir.
Okay, so my question was, let's suppose this consider as a question come to you. Loss given default is condition on what? Right? So loss given default is condition on default happens. Over here you can see. Right? So the answer is the second option. Default happens. Right? So unless default will not happen, right? Loss given default is not on any use of that, right? So how the severe loss will be if the default happens. So it's the condition on default will happen. And if that happen, what would be the loss you make, right? So expect this kind of question. Right? And here I'm not trying to like give you something in advance. We are just in a pre-read stage, but how to understand the things with the example, with the conditions, that is very important. And this material is already shared by me with these simple but good examples. Go through it today, tomorrow, next week. This will help you out for the further sessions or readings as well. But we will discuss this again and again. Don't worry, right? A lot of examples we cover even during your mocks, Q banks, every time this will be the questions would be covered, right? And I also wanted to ask you, do you think raising this kind of poll in between the sessions would help us so that I can continue? Or if you think we can
Yes,
just
sir.
discuss, then also I'd fine. Okay. Okay, let me stop share now this. Close this. Right. Okay. So first is, so let's do again a quick numeric calculation. Suppose a loan of 2 lakh dollar. 2 lakh is still outstanding. So what would be this 2 lakh? We can term this as
EAD.
EAD. Right? Probability of default is 5%. Looking to the historical situation, we have seen that lot of high probability of default is there. And LGD is also high. 40% means 40% will lose if default happens. If default happens, the expected loss would be 5% PD into loss given default if default happens and exposure to default. So $4,000 per. This is how it calculated, right? Maybe tomorrow I can also raise one poll related to this. Maybe I can give you the condition like this numeric example, and the options would be expected loss. What would be the expected loss? That's kind of thing. Okay. Risk appetite. Risk appetite means how much courage you have to bet that particular risk, right? Risk appetite is the amount of type of risk that organization willing to accept, right? Like suppose you drive a car, how much is the courage you have? Like you may meet with small accident or maybe someone find you like that with this crazy example, but yeah, when you exposed to something, right? You exposed to how much appetite you have. Like when you invest in IPO and you invest in stocks, how much courage you have, like if default happen, loss have not default, yeah, default or loss, because in bonds maybe default may have. Are you willing to take that risk on? So that is the risk appetite, simple, not a much condition over there. An organization with a high risk appetite might willing to take significant risk. Like someone, any trading company may take, may daily, uh, may daily trade in options, call and put options, lot of money they put at risk, put an open position for tomorrow, like buy a call option tomorrow, market down 3%, right? So that is a high risk. Many organizations may take the high risk because their risk appetite is high, right? Startups, they start the business, any competitive industry, FMCG, right? Still they have the courage, they have the high risk appetite, right? They take the courage to start. It may turn to a maybe Zepto kind of company, who knows, right? Okay, Money says the question, what is the difference between value at risk and risk appetite? So value at risk means uh, how much you can, it's a threshold, Manish, like if loss happen, then how much would be the, how much you are confident, like loss will not happen, like 95% probability and 5% is that 1 million loss may happen in a particular day. Risk appetite means uh, what's your risk profile, whether you have the low risk appetite, whether you are risk averse or risk seeker, right? So that is the calculation. VAR is, you can see, is a statistical measure, and this may be theoretical measure in another term, right? Someone has the higher risk appetite, someone has the low risk appetite, right? Like that. I hope this answers your question, Manish. Right. Now, this might include a quantitative boundaries as well. Like we aim to limit potential loss not more than like VAR measure of revenue in any quarter, or maintain a capital buffer such that we can survive X% downturn, as well as qualitative preference as well. No investment in speculative grade bonds. We not have any risk appetite to lose our capital. We don't want to earn higher interest, right? We are very, we want to secure our money. So we will only invest in the investment grade bond, no junk investment, no speculative grade bonds, if they want to avoid any credit risk. For example, a bank could set its risk appetite such as that 1 year 99.9% VAR. Now here's a Manish answers your questions. Like 99.9 VAR means company's risk appetite. What do you see? It's high or low? Means company want to be risk averse or risk seeker bank over here.
Risk covers, I think so.
Risk hours.
Risk because 99.9% they don't want to, they 99.9% time they want to be confident, like there is a 0.1% chance threshold limit may cross, right? So which is limiting the probability of large loss on extremely low level. Or an insurance company might decide it's comfortable with up to 10 billion of catastrophe risk exposure per event, but not more, right? Generally risk up insurance banks, they generally has the very low risk appetite because they know that they are investing the money of other people. Bank use money of the depositors, investors. Insurance use money of the insurance holder of their premiums. They invest to earn a return from them because money sits idle with them. So that they invest to earn some return. So they are not like investors like me and you, the those that can put the money at risk, like invest in IPOs and junk bonds for the high return. No, they just want to beat the inflation or just add some extra return till the time money sit with them, but not exposed to more risk, right? So their risk appetite generally is low because they also have to uh, be in the risk limit for the bank's RBI Basel norms, for the insurance IRDA, right?
So, sir, basically, through companies we can understand their risk appetite, right?
Yeah. Suppose you work for an investment banking firm, right? But
Mm-hmm.
there might be the risk appetite might higher because they works to earn profit to higher
Correct.
return. For banks and insurance, that's not the objective. They just want to use the money to translate into some investment products so that they can earn sufficient return because money sits idle with them,
Correct.
right? So what we have to understand, ensuring that the business strategy in line with the risk appetite is crucial. What's bank's business? What's insurance business? The example I gave, what's investment bank's business? What private equities business, right? Accordingly, risk appetite might be higher or lower. If it stays too far below its risk appetite, it might be foregoing profitable opportunities. Like suppose banks want to be very less risk averse, like default may happen, may they denial lot of loans. Like if someone asks why government bank not giving loan, where no particular document is that they are foregoing the business opportunity. Because for bank, what is bank's business? To give away loans, to use the money as much as possible, which sit with them, right? If they don't lose the opportunity, they will lose the earning interest opportunity, right? So it is also important for you guys like to guide particular organization. What's their risk appetite, how much risk they should take, not take, how much is the risk exposure. They might be looking at the other data and historical examples, right? Now some statistical measures. So far we discussed related to risk, credit risk, counterparty risk, type of risk, loss given default, VAR, right? Expected shortfalls or liquidity risk, probability default. Let's move switch our gears something more related to statistical measure. Time value of money. What is time value of money in simple terms?
The value of money that it has now will be more in future.
Yeah, 100 rupees you have, it's worth more comparing to 100 rupee someone give you after 1 year, right? Suppose in simple term, if you want to measure how much your 100 rupee after 1 year, that value can be reduced. How you can do that? Simply,
Discounted.
what kind of discount rate you can use? Simple discount rate, like what 100 rupees example. Inflation rate, right? The 100 rupees for which you can buy something today, after 1 year, that 100 rupees might be valued as 95 rupees, 5% inflation,
Mm-hmm.
right? Simple example. So time value of money is the concept that sum of money is worth more than now than sum of money would be in the future because money today can be invested to earn interest or return, right? A dollar today is worth more than a dollar tomorrow. This underpins why we apply discount in future cash flow. Let's take an example. If you have $100 now, you can invest at 5% annual interest, right? In 1 year, your 100 rupees will grow to 105. Conversely, the present value of 105 received 1 year from now at 5% discount rate is 100. Like suppose someone asks you, I'll give you 105 after 1 year. And you have to calculate what is the present value. then you can apply maybe discount rate 5%, 6%, whatever you can, and your 105 today maybe 99 to 100. Reverse calculation, right? This is the future cash flow. This is the present value of your, right? Don't go into this formula, these numbers, just understand this simple example, right? So in this, R is the interest rate, incident risk means at what you use as a discount. Let's take another example. Would you prefer $1,000 now or $1,000 in 5 years? Almost everyone would take it now.
Right.
Time value of money quantifies that difference. If appropriate annual discount rate is 5%, then 1,000 in 5 years worth 783 today. How you can calculate? Just simply divide 1,000 divided by 1 point, or maybe you can raise, you can do the calculation like this. Let me show you. Let me open an Excel. Right, this concept is fundamental in finance for valuation of bonds, right? Let it open. Right, suppose someone tell you 1,000 in 5 years, right? That's a 5% interest, and after 5 years, right? So if you want to calculate the present value, then you can divide this with 1 plus, and you can raise to, you can get this. Can I zoom this little bit? Can you able to see now? Because this is the
Yes,
future cash flow. Future cash flow, CF. This is the interest rate or discount, IR or discount rate or DR. This is the number of years. Is the present value of
I mean,
cash.
this just for the calculation you've taken, the 5%.
Yeah.
Okay.
Present value. This can be changed based on the situation, right? Simple time value of money concept, like 1,000 in future, right? That is the present value of $783. Condition on 5% is the discount rate you're using. 5% maybe the inflation maybe you are using, right? Time value of money. I'll see if I can pass on this. Simple example is there, but if you want, I can upload the Excel as well if you do the more calculations. Like even I can add over here. I'll add over here that expected loss example as well. And I will add this file to the sessions recording, so that if you want, you can just go through. Okay. And what this explains, it also explains why we pay or charge interest, essentially, because we rent paid for that money, right? When we give money to bank to keep for 5 years, why we get the returns for them? Because they are using our money. We can take the interest because we are not using that money for next 2 years. So we will take the interest and principal back. That's the obvious thing. Risk return relationship. I think this we many times discuss, right? High risk, high return, low risk, low return, right? So someone, it's an example. For example, government bonds of a stable country like US Treasury bonds are considered very low risk, and accordingly they offer relatively low interest rate because your money is not at that high risk, default risk is low, so credit spread is low, so you expect low return. Like bank FDs. Bank FDs in India, how much they offer? 6% to 8%. Money secure, right? Post office schemes, PPF, they offer very low. Instead of that, you go and invest in stocks, bonds. Bonds means corporate bonds, maybe mutual funds. You may earn 10 to 15% return, sometimes 20-25% return as well. But risk is added. Your money is at risk now, like it can, you may lose the principal. If default happens, if the stock market go down, any fraud happens. Suppose you want to earn more higher return. You invest in private companies, startup companies, right? Take 2-3% of equity, be an angel investors. You can earn 50-70% return as well. But chances, risk will also increase. Startup may shut down next year, right? So higher the risk, higher the return, lower the risk, lower the return. Across the investment range, ranging from bank FDs to government bonds to corporate bonds, stocks, mutual fund stocks, private equity, venture capital. In that real estate commodities also come, but that is the right. Now suppose here in this example, suppose you are a risk averse investor, you are happy with the lower return, but don't want to expose to risk, then what you will do? You invest in government bonds. But suppose you have some risk appetite, right? Then you invest in stocks, right? The prices can swing significantly. And over the long run, stocks have offered higher average return than bonds. But risk is also there. Right now, we can see last 2-3 months, that's not a good situation for the stock investors. Another example is, suppose within a bond, here we just talk about two different asset class, bonds and stocks. Within the same asset class, suppose you want to go bonds. AA rated bonds, corporate bonds may yield 3%. Just an example, don't AA rated bond nowadays in India or maybe in US not give 3%, give high. Just an example. BB rated junk bond might give 7%. Okay, if I ask you one question, if AA rated bond, if AA rated bond give me 3%, BB rated bond give me 7%, what is the credit spread?
2%? No, I think what is the
3%.
On
AA
government
rated
treasury
bond
cup?
3%.
4%.
4%. Or in the
4%,
basis,
sir.
in the basis point, it's a 400 BPS. 400 basis point is the credit risk when you are not investing in AA rated, AAA rated bond, but investing in BBB rated bond, right?
In
Next.
AAA, the risk will be less.
Yeah. It is important to note that the trade-off doesn't guarantee higher return. So don't assume like when you take, like suppose someone invest in stocks, like I took the high risk. Just a second, guys. Okay. So suppose someone taken a risk and invested in stocks and assume like now I have taken the high risk, I'll guarantee earn 20-25%. There is no guarantee, right? That's a probability. In what stock you invested, what the movement it might take, no one knows. Even the company also knows, right? So sometimes you exposed to risk, but that doesn't guarantee the higher return, right? But expected. That's why it's written expected, not guaranteed. Guaranteed return is there in just one investment, which is in bank FDs or post office schemes, right? Okay. The capital asset pricing method formula is one aspect to fit this trade-off, and which is known as the beta, market beta. What is CAPM? Beta we already discussed. CAPM we will discuss later on once we go more into the time value of money or discount rate calculation. This is one of the method to calculate the discount rate. CAPM is one of the method to calculate the discount rate. So we'll discuss it later on. This is totally altogether a different topic. So maybe I discuss or maybe another trader we discuss once it come into your topic. And beta, you already know beta. What beta measures?
Volatility in the price movement of a stock.
Volatility in the price movement of stocks, right?
Hmm.
Beta higher than 1 means stocks is more volatile. Beta
Compared to
less
the
than
market, na, sir?
with the market. What is the beta of market? What is the market beta?
1.
1. Suppose HDFC Bank has 0.88 beta. Then what do you think? Like HDFC
So
is
low
lower.
volatility compared to the market value, right?
Just yeah. So suppose you are an investor like me, like I'm a risk averse investor. I don't want to expose too much risk on stock. Then I may invest in HDFC. Comparing to that, suppose another company, suppose they fertilizer industry, Paradip Phosphate, higher beta, 1.2, 1.3, more volatility, right? But I may on return 3 to 5% in 1 or 2 days if market supports. So maybe I want to take higher risk. So that is market beta. So in
Okay.
summary, no pain, no gain, right? Pain means no one is punching you. Here the pain in terms of you have, if you could able to take the pain to see losses at some point of time, then you may be exposed to more gain, right? So that is the risk return trade-off. To potentially gain more, one must take one or more uncertainty or volatility in outcomes. Something may not go as well as what you expected, right? Next is skewness, right? Skewness is the statistical measure, like suppose like this might you might have seen this kind of, right? Positive skewness, negative skewness is a statistical measure. So what it measures? Skewness is a statistical measure of asymmetry of probability distribution around its mean, right? In a symmetric distribution like perfect bell curve is what? This is the
Normal
perfect
distribution.
normal distribution, perfect bell curve, right? Mean, this is the mean, right? And half over here, half over here. Skewness is, so in a perfect bell curve or normal distribution, skewness is 0, no skewness, right? The left side and the right side mirror each other. When a distribution is positively skewed or right skewed, it has a long tail. A few very high values make the tails on the right longer or fatter, like more higher values over here, right? Mean is there, but like suppose, let's take an example. Here, 5, 5, 5, mean is also 5, 5, 5. All values, just an example. Again, mean is 5. Let's take an example. -5, -2, 0, 5, 15, 20. Here, I'm not calculating. Let me tell you just example explaining. Here again, Mean is 5, but skewness is high, more positive values, right? Negative side again, minus 50, minus 30, right? Then 50, 20, like this. The more on negatives, like rightly skewed, left skewed, positive tail, negative tail, that is known as the skewness. So skewness, sometime what they do, right? So skewness add risk. Suppose on average, suppose there's a 10 days you invested. Average return of 10 days is 10%, right? Suppose 5%. Throughout the days, 5%, 4%, 5%, 4%, average 5%. Another case scenario. First day, negative 5%. Next day, plus 10%. Then no gain, no loss. Then 5, then 50, but average is still 5. So it depends. Skewness is more exposure to risk. Overall return not changed that much, but you are exposed to high risk. Suppose you take some decision during the negatives returns. Suppose you exit, then you may incur the losses, right? So in the negatively skewed, what happened? You have a long tail on the left side, most observation on the higher end, some extreme low value stretching the left tails. In finance, skewness is important because asset return distribution offer are not perfectly symmetric. For example, stock returns tend to exhibit negative skewness. There are many small positive days and few large negative days market crash, which creates long left tail. This means average can be higher than the median because of those red big drops pulling the mean. Let's take an example. Consider two investment returns. One, distribution. First is investment might usually returns 0% to 5%. One. But occasionally minus 20%. This is negatively skewed with a bad left tail. Suppose 0% to 5%, but occasionally 20% happens. Investment B might usually 0% to negative 5%, but occasionally plus 20% sometime positively skewed. Even if their average return is the same, their skewness differs, and many investors actually prefer positive skew, chances of big upside, right? Right, suppose plus 20, plus 10, 0, 5 to low, but plus 10, then minus 20, minus 10, average is going to same, then you don't want to take negative skews because outcome is same. So want to be more say on more greener side, more positive side, right?
Sir, I have a doubt.
Yes, look.
Sir, what's the difference between positive and negative? Can you explain it, please?
Yeah. So negative skewness means you occasionally have negative numbers as well, like over here, right? Outcome is same, like minus 20, minus 20, minus 10, 10, then 50, 50 two times only, but more negative side. Out of 7 days,
Basically,
4 days negative side.
probability of getting negative value is high.
No, not this is not probability. This is something like, yeah, probability you can say, but or historical return you can say. Historically, suppose any volatile stock gave average 10%, but that 10%, 1 or 2 days just 20% upper circuit, right? But rest 8 days, 2%, 5% negative is too many days, right? Or many times it's very higher. Another example, same 10%, but average is on positive side 8%, 10%, negative just 2-3% days. So people most prefer the positively skewed because average is going to be the same. You suppose you're going to invest in 1 month, 1 year, you want your stock not move too much on the positive side, but also not on negative side you want, right? You not want too much upper circuit to just get your negative return to be balanced out. You want uh, more on positive side, not on loss side, not on more higher side, but yeah, at least something in positive numbers like that. I hope this
Okay, sure.
answers. Right?
So
Yeah, Archita.
the way you're defining both the positive skewness and negative skewness, don't you think the
Mm.
graph should be the other way around?
Yeah, this okay, yeah, negative and that, yeah, that can. So this is the normal distribution, and left and right you can just see over here. Yeah, but yeah, the bell I just draw it may be left and right tail that you can see. But yeah, in the example, I just wanted to elaborate in that way, right? Kurtosis. So kurtosis again, and here we are going to discuss some of the statistical example on the hypothesis kurtosis, right? Let me see if we are near to
So,
take the second break. Okay, just half an hour still left, so we can. Yeah, Ananya, do you have any question?
sir, I wanted to ask that what variable is measured in this skewness? Like the risk is measured or the probability? What is the
In that,
variables in X or Y
yeah, yeah.
axis?
So in the skewness, the variable that measures is risk of big downside outliers, right? That's why we mostly want positively skewed, because in that the downside, big downside, -20, -10, -5 would be less, and more positive numbers are more, right? And negative numbers are less. So here the variables would be the uh, less. You want to be more positively skewed, so there are very less chance, very less probability or risk of negative downside numbers. I hope this answered the question, Ananya.
So no, but I mean, she's asking what the variable is. I think it's return in this case.
Yeah, okay. Return, yeah. That I already, I think, discussed, right? Return over here. So you measure the return, how much you want, negative or positive, right? So return is the main particular thing which you look at across the period, right? What we discuss over here, 5 5 5% or -5 -2 0 15 20 or -50 to 20 like that.
But sir, this only shows outliers, right? Not the general trend.
Uh,
Yeah, like big
you
downside.
generally, yeah, outliers means which are some extreme numbers, right? So
Hmm.
we generally want to avoid mainly the negative or big outliers, right? Like
Where do we get
when
these numbers from? How are they estimated? Like,
uh, if you want to see, then you can see the on the money control any database. You just see the stock movements in pandemic situation of any company, or maybe the result after announce, how positively negative 1 month scenario, 2 month scenario. You can see if stock goes down 5%, 2%, 3%, or 1%. So you can see that these are just example. But actually, if you want to see for any particular stock, any investments, then how the skewness comes. Like, and more examples on the normal distribution side, you will see some stable stocks like ITC, bank stocks, or maybe BPCL kind of company, which not too much movements, not -20%, +20%, upper circuit, lower circuit. You will not see too much in that. But some companies like small cap companies like Vodafone Idea, right? One day +20%, +15%, but maybe next day -15, 20% as well, right? So it up to you. If you want to play on a day or on a monthly basis, want to be comfortable with more outliers or less outliers. I hope this answered
So,
the question. Yep.
so return is high in positive skewness.
Uh, I would say return, when we see positive and negative skewness, in that when outcome is same. Here, see what we are seeing over here. If the average return is same, right? If the outcome is, suppose you invested in particular stock or any investment, mutual fund, suppose, or stock, whatever, for 2 years, 12% return, another also 12%. But one stock is continuously negative 20, then 20 plus 5 minus 1. Another is 1% point up point like that way. But over the period of time, 2 years, 20% is just same outcome. Then generally people prefer positive skewness distribution because it moderates the amount. Very few higher earnings, but it's fine. You don't want to see too much outliers on that side, right? But don't worry about this term and these concepts. We'll discuss this again if it comes. This is just the statistical measure. What we're discussing right now and going forward, whether it's this skewness or maybe kurtosis or hypothesis, we are going to discuss the hypothesis 0, alternative hypothesis, this or a statistical measure that the risk managers take into consideration when they looking at the risk and return side of different investments.
So,
Yes, look.
so can we describe this as a frequency, so like returns, like frequency on getting those numbers?
Yeah, sequences like suppose today, tomorrow, then what happens. So you have to take the 1 month trading days, 1 year trading days to see how much is the skewness of any particular uh, how much is the skewness of any particular stock or any investments, right? You can convert into charts, into bell curve. Generally, there are some tools available that which people use, right? We are not going to do it right now because it's not needed, but that
Okay,
they
sir.
can do. Just they can just plot the risk on any bell curve to see whether it's positively skewed, negatively skewed, normal distribution is there, what is there, and how companies comfortable, right? Generally, in the mutual funds, in the insurance company, banking company, they generally look at uh, as per the regulatory requirement how much they can export to some risk or not. So skewness they take sometimes into consideration in that. Will the actual class again start with the basic, Abhishek? Yeah, so these are the pre-reading, Abhishek. These all concepts in one way or another will again come into reading. VAR, expected loss, LGD, this time value of money, everything will be there in your maybe regular studies as well. So don't worry. And this will be repeated again and again, as I told you. So don't worry about that, right? Yeah, Harshita, do you have any question? You raise your hand.
Yes, sir. I still have a doubt.
Hmm.
If we are talking about positive skewness, so what does it mean? That more number of values on the right side, or just few higher values on right side?
Okay, so let's discuss it again. So when a distribution is positively skewed, rightly skewed, it has a long tail on the right side. A few very high values make the tail on the right or on the fatter side. So very few high, but little bit very small numbers on a lower number side, right? So let's say over here, let's say this investment B might usually be same 0% to 5, but occasionally plus 20%. So very few 20% or 10%, but few numbers are 1% or maybe 0%, 0.5%, but more on positively skewed, very less negative numbers, right? Outliers are there, but very less. So generally people prefer, though 1%, 0% is still there, but 1 or 2 days, some higher numbers that can make their average return. Those same, like, let me give you one example. I don't want to see my stocks go down to negative 2 to 3% very often. Though it stay 0% or 1%, but though market is 3%, but I'm comfortable with 1%. But when market down 3%, my stock is still minus 1%. So I want, so that is positively skewness. But suppose someone is there, I'm comfortable with the stock like Vodafone. One day 20%, another minus 20%, then minus 10%, then that is there. So in this positively skewness, like your fatter tail would be, right? A few higher values makes the tail fatter, but small little bit values should be there over like this. In the tails would be there. And just a measure, right? Sometimes companies take this measure in terms of how they wanted to look their return, how they wanted to see the volatility, right? Kurtosis is another statistical measure which describes the tailedness of a distribution, in the particular how heavy or light the tails are relative to normal distribution. It also relates the thickness of the distribution. A normal distribution has the kurtosis, excess kurtosis of 0 by definition, like this, sometimes quoted as kurtosis of 3 in non-excess form. Don't go into too much number y0, y3. See, in the statistical measures, bell curve, normal distribution, right tail, left tail, skewness, hypothesis, this would be there, right? These are just statistical measure which people use to measure the risk and return probabilities, positive numbers, negative numbers, right? Heavy tails, fatter tails. So just take it as given as of now, right?
Sir,
Don't try to
my
learn or
sir,
yeah, Tanvi.
yeah, sir. What I'm saying that discussing all cortices and skewness, before discussing these two terms, can we discuss central tendency first and normal distribution so that it can be understood by everyone? Because see, this is an
Yeah.
overall value and it may be not understandable by everyone. So there
Yeah,
is a problem. There is
I
a lot of
got
things.
you. Yeah, but normal distribution and that, so at time comes, so I explain like in between like what is normal distribution and that, Tanvir, because that is something very basic, so might be I try to avoid that and go ahead with other related measures. So
I think we should cover the central tendency, a normal distribution, and then we can jump to these particular terms.
yeah, we can, right, but
If it
that
is
I think,
possible, sir, yeah, it would be very beneficial for everyone.
yeah, but I think we that I try to explain with as in time comes, like here I explain like what is normal distribution with the example, though I have not separately
Because
titled
see,
it, right?
this is a pre-learning, and even some people are not able to understand in pre-learning how they will cope up with the
No, but
Rajdhani Express.
again, I can cover that thing in way like what we are covering over here, right? We will discuss again and again, and this would be like just to like keep you mentally prepared, like what you can expect when with the FRM program. Like though it's a pre-learning, but some of the topics like which I have over here that might be also there with the regular studies as well, right? So don't think in that. And Tanvir, I'm just addressing to all the audience, right? To your question, yeah, normal distribution and that definitely I not have the separate tag or separate title, but yeah, I try to cover during this Q&A. But again, if required, like suppose here also in the kurtosis, I'll try to do that, right? And as I told you, don't try to go too deep into this terminologies and that, because these are just for the reference. You already have the material, you can go through it. We will discuss this again and again. But what I'm trying to communicate over here, what the things you may face or may encounter when you deal with the part one or when you actually work, because it's not just the education, it's just the how you apply in actual learning, right? And these are randomly picked. This may you sometimes what happens, we learn or study that, but we apply in learning in a different way as well, right? So in that context, I try to put in over here. Yeah, but definitely whenever you feel something, if you want to suggest, you can. And Tanvir, I appreciate like you can do, you're doing that.
Thank you, sir.
Yep. Right. So in normal distribution, kurtosis, excess kurtosis is of definition by 0 and sometimes quoted as the kurtosis of 3 in non-excess form and serve as a benchmark of mesokurtosic behavior, right? If a distribution has a high kurtosis, don't again go ahead with the uh, too much definition detail. If you want, I can skip as well, but I try to just cover in uh, quickly, right? These are just the terminologies, right? Like in higher probability of very extreme outcomes compared to the normal. It often also has a sharper peak. If a distribution has a low kurtosis, which is known as this, right, platykurtic, it has thinner tails, fewer extreme outliers than normals. Means outliers will be very few, right? In finance, kurtosis matrix matters because asset return often exhibit fat tails, right? Very high 20% upside, 20% downside, fat tails would be there, right? Like in crashes and booms, when crash happens, negative 10-20%, you can see when booms happen, 10-20% can be another way around. For example, daily S&P 500 recent have historically shown leptocotic behavior. There are more very large moves, both ups and downs. It's 20%, 10% higher, 10%. Then you would expect under bell curve assumptions, means normal distribution. This is one reason value at risk model that assume normality can underestimate risk. They might say phi sigma event are virtually impossible, yet in reality such events occur more often, right? 5% sigma means phi sigma events means we may think like pandemic may comes once in a century or war situation may comes, but it comes, and at that time normal situation it's not there. That's why value at risk. Sometimes we have to keep the threshold. If something happens, what are the chances we can able to lose, or we have the appetite to lose, right? Let's take another quick example. I'm skipping this because don't want to go too much into the definition side, and you can go through a quick examples with numbers. Suppose we have a normal distribution versus a leptocotic distribution with same mean 0 and standard deviation of 1. So normal distribution generally have 0 mean, mean is 0, sorry, and standard deviation means risk is 1. That is the by definition there, right? Elliptocotic is under normal situation, the probability of a move of more than 3 standard deviation from mean is about 0.3%. Under a leptocotic distribution, the probability might say 1%, significantly higher. That kurtosis at work, right? In summary, kurtosis alert us to presence of outlier prone distributions, means more outliers are there. Probability is high, right? Risk managers pay attention to kurtosis since high kurtosis fat tails implies a need for more capital or hedging to protect against those rate but impactful events. Means when high fat tails are there, then what you have to do? You have to put your capital at reserve if some loss happen. And what is there? If you want to put some more capital, if very high percentage like 10%, 20% higher risk, then capital or hedging, these are the two things you can follow with the kurtosis, right? Again, don't go too much in detail, right? Just wanted to cover some basic detail along with the skewness.
So,
That's why I kept it. Yeah, slow.
so basically, flat tail is more risk, right?
Fat tail, right? Yeah, fat tails
Yes,
means,
sir.
yeah, yeah. So this, let me show you. So this is the area which general risk managers try to pay more attention and how to manage with the more capital or hedging. Because if it's a
Okay.
normal, then it's fine, right? Yeah, more volatile as Mithil mentioned, right? When it's more volatile, you have to place more attention, right? More skewness, kurtosis can, or more extreme outliers, risk managers try to understand and how to deal. You cannot avoid it, right? Here, avoid is not the option, but how to mitigate the situation, how to minimize the losses if that would be, or how to manage the capital and hedging position in this situation. That's your job.
So basically, the graph will have a sharp curve, right?
Yeah.
Okay, okay.
Hypothesis. Any basic understanding on this term, hypothesis? What hypothesis is? You might have studied in your graduation or maybe masters or during your schooling days. What hypothesis try to communicate? Anyone? Okay. So hypothesis is the testable statement or assumption that population. So any particular thing may happen. Comparison between two variables. Like suppose you flip a coin. Suppose you toss a coin. What is the chances of head versus tail? Right? How many times it may happen? Right? So let's take an example over here. The analyst might hypothesize that a new investment strategy has an average return of greater than market return of 0.5% per month. Right? So you may set, so there are two kinds of hypotheses. Null hypothesis, right? Often repeat as a status quo or no effect, right? Example, the mean return typically 0. Alternate hypothesis represent we are testing. If it is not 0, then what? Right? It's positive or negative. So we then use the statistical distribution again. Hypothesis is something which you wanted to test the situation, like return probabilities, or if this is not, then what else? Okay, Harshita has the comment like I'm a first year student. I can understand Harshita, right? And that's why I'm not going into detail, but some basic understanding. Going forward also we will do that, right? I noticed like this might be something too deep for you, right? Time value of money, I can understand it's a simpler one, but once we start uh, statistical measures, right? Hypothesis, skewness is that. So just we are trying to understand to let you know like these are the concepts which you may encounter. And I'm not expecting you guys to understand it fully. I can understand, right? So I can understand, uh, and uh, and this is just the first time we are discussing. We'll discuss again and again. You have the material, even you can go through with examples, right? It is like, and my only suggestion, don't try to get everything at once, right? This is normally what I do when I understand something. Like just understand the concept, keep in mind this is something is there, right? When again it will come, okay, I know the something is there, now let's understand again. It's like when you try something first time, like suppose when you drive a car or a bicycle, right? It takes time, so it's a gradual process, but you start, you learn. So this is like that, but you don't have an expectation like in the first day itself I would be the perfect driver, right? So I think you guys are trying to, don't try to mug up the definitions or try to understand everything you are getting over here. This is the first day. For some of you, this is might the second day. 5 to 6 months is there. You're going to learn and read and understand and go through the example more again and again. It is something like when we encounter something first time, we face some difficulty. I hope you are agree with me, right? But it doesn't mean like it's not going to come to us. It's going to come to us, but at least we should. I hope this works, right? And we will not cover too much in detail, but yeah, something like what is there as a concept and what you can learn. That is the only thing try to convey over here, right? Again, hypothesis, let's understand with a simple example. A simple everyday example. Suppose one claim a coin is fair, 50% chances of head. So null hypothesis will be 0.5. What is the other chance? 50% will be the tail. So your another hypothesis would be 0.5. You flip the coin 100 times, you get 60 heads. Let's say you get more heads. You might test whether 60 or more heads in 100 flips is likely. Your probability or hypothesis is 0.5. The probability of 60 or more heads out of 100 for a fair coin is 2.8%, right? if our significant threshold was 5%, like 5% is the threshold, we would reject null hypothesis. Say that's the evidence coin is biased. Like how it, let me explain this again. Suppose our threshold is 5%, like 5% should be there of we get heads when we do, but suppose it's just 2.8%. So in the hypothesis, what we do, we reject or accept the null hypothesis, right? So if something is favoring, then it's fine. It's not, then like suppose if we got 52 heads, the probability of 52 or more higher is around 30%. So we would not reject, concluding the result is consistent with the fair one, right? So just one example, right? But what we are testing, what we are expecting, that is the hypothesis, like what should be there. If it is something like 50 heads is there, but suppose now 60, what are the chances? If we reject, like our null hypothesis, reject if more than less than 50. So if it is less than 50, then we will reject. Accept is more than 50, then we will not reject, or not reject more than 50. Hypothesis generally measure in, this is just a coin example, but in terms of returns. Invest in any company if returns are in every day not less than 2%, right? So you test the hypothesis, you do the distribution and you try to check it. Reject if more than 2%, right? In FRM and finance, hypothesis testing could be used to verify claims, like a particular trading strategy has zero alpha, means excess returns. Risk models prediction match observed data and two data sets have the same distribution, right? Remember that failing to reject hypothesis, null hypothesis, is not the same as proving true. It just means we didn't find strong evidence against. Just means like you don't have to feel like something is favored in you, then means you should go ahead and invest and you are right in your assumptions. But it just means you don't have like negative 2%. You don't find too much evidence like that's a negative 2%. Whether you want to invest in this company or not, that's a completely different decision. But that's your criteria. Then you can test other companies as well, right? And accordingly you can decide, right? Type 1 error, type 2 error, we will discuss later on. We don't want to dig that into. Fat tails we discuss. Probability distribution, extreme outcomes, this we already discussed. Far from the mean, like this. Fat tails, right? Or maybe like this. This is the normal distribution. So far from normal distribution, right? Now, what is tail risk? That let's discuss that. So in finance, tail risk refer to the risk of extreme losses. Tail risk, like what earlier someone asked the question, right? Left tail, right tail. Extreme losses and fat tails imply higher tails. Like an example, 1987 crash, 2008 crash, right? So in that extreme situations where that could not able to control, could not able to wind up this your positions, your open investment positions, and that can cover losses, incur losses. Because a normal VR could not able to capture them. A normal VR threshold is that 5%, 1 billion loss. But suppose this kind of thing happen, right? Negative 20, 10%, then your threshold could maybe could not able to cover the position. Fat tails can arise from mixture of distributions, volatility clustering, a structural reason in the market. Structural reason like right now when Trump announced the tariff, right? A couple of other reasons, economic slowdown is there, right? Or maybe the GDP growth rate was down. So a couple of reasons that mixed up and maybe try to give us the fat tails, too much continuously negative.
So one question.
Yes.
So are we saying that fat tails are always when it's going negative? Or
no, it not. No.
not
it
yeah.
no. as I told you, it can be crash or boom situation. Crash or sorry, crash or boom. In crash, what happened? Too much negative skewness or lot of
Negative.
negative, right? So maybe fat tail is there. In the boom situation, lot of positives, right? But in the fat tails, what happens, right? We could not able to understand how long it will go. Crash would be there, and then when it will recover, when recovery will come. In the boom situation, what happens? Whether we want to put in more money, if when to put, like suppose today we put in, but from tomorrow boom situation become normals, right? So in the fat tails, try to understand the situation, how much risk we are taking compared with the normal distribution. It's very difficult. So risk managers try to understand more in that, whether it's a stock investments or bond investments, right? Whether it's a volatility or probability of default, that kind of. I hope this answered the question, Nancy.
Yeah, it could be from both the side, right? It could be a positive or a negative.
Yeah, but generally, risk managers try to uh, make precautions or understand more on that, because negative side is something is related to loss, something is related to minimizing the loss. So you more often try to get understanding in the worst case situation, in the like 1987 stock crash or 2008 finance, like this kind of situation. You try to pandemic kind of situation. You try to focus more on that side, right? But it can be both sides, right? Now, what is the problems with fate tells? Can we take a second break quickly, 5 minutes, and we can come up and discuss things, right?
Yes, sir.
Okay, I think it's a too much uh, statistical things. I think 5 minutes can be a good thing.
Yes,
10
sir.
minutes.
Yep. Guys, can we start now? Okay. So what's the problem with fat tail? I think this we discussed, right? It's to pose significant challenge in risk management, because in the risk management, it's very difficult for us to write probability of extreme events. So that is something beyond what standard model assumes normality of thin tails, right? And one major problem is underestimation of risk, right? Like in 2008, what happened? Like it's very difficult to any Lehman Brother kind of big company can fail and it lead to financial crisis and lot of credits or lot of outstanding payment could not able to recover, right? So to get that understanding with the fat tails, it's very difficult. Like
So
what
one
we
more
discussed.
question here.
Yeah.
You mentioned problems of fat tails, but you also said that it can be positive. So when it's positive, meaning it's good, right? Then why it is called as problem?
Problem it tails like to get the understand. And as I told you, like when it's positive, it's not, and we don't try to focus and on positive side, like it's not going to impact that much unless and until it's come to like we miss out an opportunity, or suppose we invest today and tomorrow what will happen, to get that understanding, right? So it's fat tails both side, right? It's positive returns, negative, positive outcome, negative boom and crash situation, but it mostly create problems during the negative outcomes, during the something which is unexpected occur on negative side, right? But when you ask fat tails can be on both side, that's why I told you it's on both side, but problem arise when it's mostly unexpected events on the negative side.
Okay.
Right. This historical simulation and this, I think, model risk we discussed, right, which give us a false sense of security in that. But this, I think, we can discuss later on, I believe, because of some of you otherwise feel like it is too much deep. But as is the pre-read, we can. It is there
Excuse me,
in
sir.
the. Yes, look.
So on average day, the flat tails is mostly negative, right? Like we are talking about very unlike possibilities here.
Okay. If you see the recent last 2 months in India, so what do you think? Is it look like a fat tail on negative side?
Mostly on negative side.
Right. So we can say in any company or any index, mostly in the company index, I think that market try to move in cycles and that happens. But with it can be negative side if it is a normal, not distributed, can be, but not more on positive side. Otherwise, stock can be anywhere, right? But if it's not normally distributed, then it can be volatile. And the best example, if you want to look at, you can look at the Vodafone Idea. You can look at the Suzlon Energy. This kind of examples, lot of fat tails, right? Extreme outcome, extreme outliers, right? I hope this answered the questions. Look.
Sir, we can say that negative fat tails are not good and positive are good for the.
Good in terms like as a risk manager, see, you are not going as a risk manager. What I would say, our duty is not to chase returns. Our duty is to minimize the risk, divert the risk, going less wrong, right? That is, I think, our job is. So focusing on uh, fat tails during the crash situation like this might be you want to study more, you want to be more vigilant. so that you don't underestimate the risk. I hope this answered the question, Ishita.
Sir,
Yes.
Yeah. Yeah, Ananya.
sir, as fat tails are on both the side, like on the positive side and the negative side. So, is it like that the negative side of the fat tails is not sufficient enough to estimate the loss or something? Is the
Yes.
problem?
Yeah, that is the estimate, or that the problem is we underestimate the risk. The
So it
problem is
can
with
go worse.
yeah
Like it can be worse than what is the
expected.
negative fat tail is showing.
Yeah, it is worse than what is expected. Like in VR, what we expect, but this is worse what we expected. What is threshold, or what is our risk appetite, right? Like suppose I invested in Vodafone Idea, considering like I may get 15% in 2-3 days, but my instead of 15% plus, I'm sitting in negative 20%. So something which is not expected, which is not like under my risk appetite, or I underestimated the risk. Okay, this is a more volatile stock. I might have considered the situation as well. So that might be I'm underestimating this. So in the fat tails, the in general in the risk managers, what they do, they either try to minimize the risk of avoiding this kind of investment, or if they already entered into and some situation comes in, then how to cater the situations in terms of hedging or capital or protection, how they want to go ahead with that. Bell curves we discuss, it's a casual name of normal distribution like this, right? Which classically symmetric bell shape probability of distribution. I think you can go through this, but what bell curve often assume in many statistical methods due to its nice mathematical probabilities, like central limit of theorem, like mean reversion, sometimes negative 2%, negative 1%, 0, 5, 10, 15, or negative. But in mean, it is overall, you see, mean would be if you go left side or right side, numbers are not too far, right? It's almost nearby, right? And we discuss the same thing. So it's just a heavy tailed or skewed in earlier, the same thing, mean and standard deviation, right? For normal distribution, mean is standard deviation is 1, right? And that assume like mean is 0, right? It's a normally distributed in between, or 5, 5, 5, then is negative 10, negative 5, 0, plus 5, plus 10, like that way they do. Now something we get out of that statistical measure, and we'll discuss later on. But yes, something on financial instrument side I have, which I want to cover, which you can expect uh, in your uh, in your studies as well as in your exam as well, right? Okay, equity everyone knows, but if I ask you, what is the difference between the public equity and private equity in terms of investors or return, how you can define? Yeah, Abhishek, do you want to share something? What is private equity? Can you guys invest in private equity?
Any shares which are not listed in the stock market.
The startup
Okay,
equity.
startup equity. Okay. Can as a retail investor, can you or me can invest in private equity?
No.
Okay. Okay. Let me ask you
What
in
about
SAC.
connects?
Yes, look.
So what about connects? Like if you have connects with the company, so you can.
Okay. Okay. But there are some platforms. If you just search, you can invest in private companies in some tranches nowadays in India also available. So you can, but yeah, risk is there because lot of things, lot of details you cannot check. What you can do for the public company, right? So equity instruments or equity stocks, I'm not want to go into details, but once you buy a single stock of any company, you become a shareholder of the company or the partial owner, right? For example, buying 100 shares of Apple, you become a tiny owner of Apple. If Apple's profit grow, the stock price grow and your returns will grow in terms of dividend if company issue dividends, or maybe in terms of stock price appreciation, right? So return can come in two forms. One is stock appreciation, another one is the if company issue the dividends, right? But what is the risk over here? If Apple hits a rough patch, right, then the stock could fall and dividends could be cut and you can bear the risk as the owner, right? Now you are the owner, you have to bear the risk as well of minimum, like you may incur the losses as well. Suppose you invested it $50 per share. Right now, I think Apple is 230, 240. When I invested, I like wind up my position. I've seen, I right now don't know what's trading right now, but suppose you invested it 230. Something happened like new iPhone launch, not work well, US recession, market down, market crash. At 230, maybe 200. So as an owner, you may have to incur losses. Equity can also refer to the book value, right? In terms of accounting, right? Can also refer as a book value or the shareholders of equity, means asset minus liability on a company's balance sheet or owner's equity, right? What is ETFs, index fund? Referred sir will discuss later on, but it's also kind of a when we talk about equity, so there are generally two kinds of equity. One is the common equity, means common shareholders. Another one is the preferred equity, preferred shareholders. When you buy a stock, you would known as the common shareholder or preferred shareholder. What do you think?
Common.
Common.
Right. Who can be preferred shareholders? What is the difference between common and preferred? Do they get
Maybe
anything else?
FIs.
You get any preferential rights?
Okay. Did you get dividend also sometimes with the preferred shares?
Yes, yes.
Right. So there are kinds of preferred stocks. Convertible preferred stocks, like over the period of time, preferred share will be converted into common shares. Then maybe you can get the dividends as well, right? 5%, 7% dividend. In summary, equity is the ownership and claims on uncertain future success of a company as well as losses as well. A real world examples are there, right? If startup has 1,000 shares and you own 100 shares, you own 10% of the company. If startup gets sold at $10 million in future, the theoretically your 10% stake would be worth $1 billion.
So this is
Sir,
private equity, sir. When you
yeah,
own the shares, when you own the
yeah,
shares,
this is
okay.
yeah, and even in the public company as well, when someone buy the company and the stock price move ahead, right? Suppose you own 10%. Here I'm giving the example because the company entirely bought and sold. So you will also sell your shares, right? So what a percentage, but sometimes in merger and acquisition, stock price movement also can help you to get good returns. But yeah, this example is for the private. Aditya has the question, sir, how are preferred share traded? Generally, preferred shares don't trade in public market because low liquidity, not buy and sell frequently happen, but generally it is given to big investors like HNIs, high net worth individuals, or maybe the institutional investors. They generally get the preference shares, right? But generally you cannot find in common stocks. It's trading every day. It is not trading in that way. Preference share, I think we already discussed, right? Fixed dividends, like 5% dividend, 7% dividend. Then you will get, it's like a bond. It has the mixture of debt and equity instrument, but generally in the accounting, it considered as a debt, it's a equity, not as a debt, because they have some rights above common shareholders, but as well as some convertible options. Even the debt also has the convertible options, but there are some thin line difference between these two. That's why when you raise money, right, in form of equity who preferred shares in, so it's not compulsory like you may give dividend or not. It types that defines, but in the debt something is there which interest tied into that, right? So this is the, what are the key features? So dividends, you may give priority. When I say priority, then suppose company liquidate, what is the normal priority structure in terms of payment to the obligation? Who will receive first, then who? Anyone has any idea?
Preference shareholders will receive first. While
Preference share
binding on
receive
the
first
company.
before common, right? Okay. Before preference share, who gets the priority? Suppose
They cover all the liabilities, all the
Debentures,
debts.
debenture holder.
debenture holders, debt
Secured
holders, right?
creditors.
Creditors, right? Suppose in the cap structure, there's a cap structure in this 20 crore is debenture, or 20 crore debenture, 10 crore is the loan, right? This is the debenture. This is the debt, long-term debt, suppose company has. Then 5 crore is the preference share and 30 crore is the common shares, right? Then when liquidation or in bankruptcy, something happen, the wind up, then debt will be repaid first. So suppose company left out with 20, 10, 30, 35, 65. Suppose company just left out with 55 crore when they liquidated, right? Then these three will be fully paid out, but common shares will receive whatever they have, around 20, right? Reverse situation. In this, when company got sold, suppose at 85, then this will get whatever they have the obligation, common shares holders will benefit the gain. So it's when you have the ownership, so ownership means when both gain and pain both will go together, right? This is the main difference sometimes with the debt. Debt has some fixed terms, right? 10-year long-term debt or debentures, but generally preferred shares are like in common shares. Until you hold, you can be the part of the company. Hybrid behavior, as I told you, sometimes it work like a bond, sometimes it work like a, in the convertibility, it work like a equities as well. Example is given over here. You can go through, you have the file, right? Preferred shares are, common shares are called private equity, sir. Uh, so when say common shares means, let's take an example. When you buy 10 shares of any company, suppose TCS, right? So you will be the common shareholders. and you buy the same 10 shares of any private company, suppose any company, right? Then again you will be the common share. So when you hold the equity shares, not preference, the common share equities, like generally like in the Shark Tank when they invest in companies, right? 2%, 3% equity, they become the shareholders of the company, common shareholders. And suppose they same invest in TCS or HDFC, then again they are the common share. So it's not related to private equity. It may be private equity, public equity. When you buy shares, you are the common shareholders. These are the common shares. I hope this makes sense, Vancy.
Okay. Yeah.
This example, I think you can go through. Very nice example. I have put in over here with a condition also, right? But preferred shares often used by companies to raise capital without suppose though they don't want to dilute the common equity or voting control. Generally, the preferred share come up with the uh, or don't want to add that also on balance sheet. So they use the in between situation where with preferred shares, like they don't dilute the ownership as well as they don't want to add debt, but 5%, 7% preferred share right now. After 2 years, you can convert if that's a convertible preferred share, right? In some, preferred share sits in between bonds and common equity in cap structure. They get preferential treatment over common stock for dividend and liquidation, hence name as preferred. However, they typically don't share in a big upside of the company beyond their fixed dividend and can be riskier than bond since bond get first over here. Suppose company just left with it's the 30 crore. Then in 30 crore, debentures and debt will get paid first. Preferred share will not, but this is the only risk, I think, in terms of liquidation or bankruptcy, preferred share might face. Okay. Some of the primary market and that kind of details. Okay. Any simple difference between the primary market and secondary market?
Primary market is the first issue market, and secondary market is the second issue market. Where
Okay. Yes, look.
Yeah, in primary market, we trade newly issued share, and in secondary market, we trade like issued share already, like
Okay.
exchanges.
Let's take an example like
IPO is primary market
yes.
and FPO is secondary market.
Okay. So when you suppose today any company got listed, right? Suppose any recent IPO came, Hyundai, right? So when they first issue, when they convert from private company to public company, so that is known as the IPO, right? When a private company offered shares to public first time, right? When Facebook went public in 2012, it sold its shares to investor in an IPO, so that is known as the, after that company is a publicly traded. So this is the IPO. After 2012 to till now, whatever buy and sell happen in the Facebook shares, right? Then that is happen in the secondary market when you can also buy, I can also buy, I can also sell. That is right. But a primary market is a market where new securities are created and sold to investor for the first time. It's not just related to stocks, it's also related to bonds as well. Right? When any new bond issuance came, right? So it come into the primary new bond offering. When a new mutual fund came, new fund offering, though they already like invest in the already available stocks, but whenever any new fund, new bond, new investment offering comes, then it come in the primary market, right? The issuer is the company or maybe the government if it's a bond, and receive the proceeds from the sale. Like suppose they sell the shares, bonds, then they receive the money and they give you bonds, shares which you hold. You might be the shareholder and bondholders, right? So IPO SEO is the seasoned equity offering or follow-up offering, that is also known as the FPO. If a company is already public but issue additional shares, like suppose before some time, like recently, I think Vodafone Idea, they came up with an FPO, follow-on public offering, right? Uh, so companies already listed, but they want to raise some more money, so they issue some additional shares. That is known as the FPO or follow-on offering, right? When company first time raising money from as a private company, that has to come through the IP. Debt issuance we discuss, right? When when any new fund bonds, not funds, sorry, any bonds comes, right? Suppose US Treasury, they hold a new batch of Treasury bonds in the primary transaction. The government receive the fund. Similarly, corporation issuing a new corporate bond via investment bank underwriting. So that also. So the first time sell the bond, you will buy, you hold 5-10 years, and you can also sell the bond. Suppose maturities of 5 years, but after 2 years, suppose you want to sell the bond, someone to, you can also do that. Private placements. This is something new for you guys, might be. So this is the primary market transactions by securities or equities or debt are sold directly to a small group of institutional investors. Like sometimes companies want to save some time and cost instead of, like suppose they need some extra money. Like suppose they came up with an 500 crore IPO. After 2 years, suppose they need additional 20-30 crore. So they will not go ahead with the retail investors. They will just go through some key institutional investor like 2 to 3%, which can invest in them directly. So they will directly transfer the share. They will decide the price, whatever the price would be. In bonds also in the same way, right? So when you sell your equities or bonds to small group of institutional investors, that is known as the private placements. For an example, a startup might raise money by issuing shares to venture capital funds, private placement equity, or company might privately place bond with a pension. They will not go to public, but they will do some privately with one or two parties. No doubt they have to mandate with the regulatory bodies, right? In terms of stocks with the, if it's a private company, it's fine, but it's a public company with the SEBI and that they have to issue the circular and the document they have to submit. Right issue. Any idea about this? What is right issue? What is it? Who can get it?
Giving shares to the
Shares are offered
existing
to already
shareholders.
existing shareholders.
Okay. Yeah. So a company can give existing shareholder the rights to buy new shares at a discount in proportion to their holdings to raise capital. And it's up to investor if they want to apply to right issue or not. It's not compulsory. They give you the option. Like suppose I hold a ITC share of 300. If ITC issue right issue, they come up with the right issue. Like if I hold 200 share, I will get additional 100 share, right? So that's a 1:2 ratio, like 1 share out of 2 shares. So I'll get additional 100. Right now, suppose trading ITC at 300, then I may get it 280 or something, some discount, right? So that is the right issue. But suppose you are not a shareholder right now, but somehow you got to announcement or maybe to the company's earning call or their press release, you come to know like next 3 months, company may, or they also give you the date, company will issue, company will come up with the right issue, right shares. And if you want to participate, can you do that?
No.
No, sir.
Okay. I think you can, right? But you have to just fall into, you have to buy the shares before the
Record
uh,
date.
record date, right? So suppose you already hold the share, then suppose that's a record date, or suppose the time period is there within these 15 days, you can apply for the right issue. Before that, you may buy the shares. Like, let me give you an example. Right now, I don't hold any ITC shares, but I know company is going to come up with a right issue in next 3 months. So after 1 month, suppose I buy 300 shares, and after 1 month, suppose company come up like, if you want to apply for the right issue. So before company came up with an issuance, I am the shareholder, right? Same with public do with the dividends as well. If you know, company issue the dividends, announce the dividend. Then to get the dividend before the record date, they buy the shares, they get the dividend, and after that, after the record date, they sell the shares. Many people do that to get the dividend. Same with the right shares, also they do that. Preferred stock, I think this we discussed. Right here, one example is given. So in the IPO market, what in the primary market, security right now it's not trading. Suppose Hyundai decided the price of 1960 or 1950. They want to come up with the issue price. You can apply, and if you get the allotment, you will be the shareholders. But before that, it was not trading. So how they can decide the price? So they set the price like through the book building process. The underwriter, they first of all decide the valuation. This much money we want to raise. Like Hyundai is the largest IPO in India ever. 27,000 crore they raised. Right? In a history in India, no one came earlier than that. I think LIC or Coal India and Paytm was there. So how they decide the price 1950? First of all, they decide how much they want to raise. Then they decide like what's the valuation we want to give to the per share value. Like that way, they decide the price. We're not going to go deep into about that, but just to give you some normal idea. Let's take an example. A corporation need 100 million for expansion. They decide to issue 10 million new shares at a $10 each in an IPO. Like, so they are earlier than private company. They want to do expansion, right? So in the primary market, investors subscribe to the IPO and buy at $10. The company does raise 100 million minus fees like SEBI fees or listing charges. Once this share are issued, they will start trading in the secondary market. Means after applying, suppose $10 sell tomorrow $10.5, you may sell it. Someone else buy it. Then at 11, you may sell it. Then 10, 11, 12, 15, 10, 5, whatever happens, that happens in the secondary market, right? Another example, the World Bank issue a 5-year global bond. Here we talk about stocks, now the bond side. In the primary phase, it might be sold to a syndicate banks who then sell to end investors. So World Bank will not directly deal, but some of the investment banks, syndicate banks, they do the work for the World Bank and they raise the money. An end investor like you and me can apply. The primary market transaction is the World Bank receiving the fund from those banks, right? Or maybe sometime directly from the investors as well, like you and me. And after that, you can also sell the bonds to the third party or maybe to the broker, whatever you want. You can do, even you can hold till maturity as well. 10 years, 20 years maturity is there, you can hold it. All right. Secondary market we discuss, right? When buy and sell happen, not only for stocks, bonds, and other instrument as well, like whatever the investment option you can do buy and sell again and again for any particular investment class, right? And there are exchanges for the shares like New York Stock Exchange, Nasdaq in India, which is right. NSE, BSE is there, right? Bond market. So in the bond markets, you cannot like once you place the order in the next second, you can able to sell or buy. That happens with the share, but with the bonds, it may take some time because it is the over the counter. Means some broker can be the mid party. Suppose you want to buy and sell, you have to place the order. Maybe in 1 or 2 days, the transaction may happen because bonds investment or bond asset class is not that as liquid as stocks, right? You can buy and sell uh, within seconds, but with the bonds, it takes some time, right? Because it's not a centralized exchange like that happens with the stocks. Dealer will quote, like dealer means broker, for buying and selling bond, and trade happen through broker dealer network, right? Means any third party in India, there are India bonds, Golden Pie, these are the sites, right, in which you buy and sell happens. Secondary market for other instrument as well. So this include exchanges or OTC trading for options, futures, right? You can buy call option, put option, futures as well on NSE, BSC, or maybe any global exchanges as well. And sometimes loans trading as well, but in particular situation with particular institutions, right? Not very often. Even as a retail investor, you and me cannot participate in that. Secondary market for funds, for example, ETFs. I think earlier we not discussed this, and we can discuss this now, right? So ETFs trade on exchanges like secondary market trading or fund of share or closed-end funds, but these are something like you can trade like shares, but that mimic to index or any particular uh, group of companies. Anyone know any index name? Any not index name, any ETFs? Anyone trades in ETFs? Anyone bought or sold? Any idea? Okay. Guess someone responded. Current Nifty Bees, Bank Bees, Yamitil Gold ETFs, Nifty Pharma. Yeah. So there are a lot of ETFs like that mimic the set of index or company. Like there's a group of pharma company. So that's one index is there, right? Or maybe not an index, but that ETF that may mimic to the that pharma companies, whatever the uh, movements happen in the pharma companies, that ETF mimic. Nifty Bees that mimic the Nifty 50 stocks, right? So that is works like shares, sometimes very low, sometimes low liquidity comparing to shares, not too much volume, but yeah, you can buy and sell easily like shares you do, right? Let's take an example. After Facebook IPO primary market, those shares began trading on Nasdaq, right? Nasdaq is that is the index in that it is trading. If Alice buy 100 shares of Facebook from Bob through Nasdaq, that's the secondary market. Trade money from Alice to Bob and shares grow from Bob's to account to Alice. Facebook, the company not involved, doesn't get any money. So Facebook not involved, buy and sell happen with the two parties, the secondary, right? Another example, you bought a US Treasury bond in auction, primary. 2 years later, you want to sell it. You go to the secondary market, perhaps through a broker, and sell it to another investor. US Treasury, not part of. So in the primary transactions, only companies or the issuing company that would be the party. In the secondary, that is not company, government, whatever buy and sell happen between the parties, right? Secondary market are crucial as they provide price discovery and valuation for security after issuance. Like suppose in the primary market, Hyundai issued at 1950, company got money if someone bid at that, right? But some right now share is trading at 1600, 1700, 1800. So that is the price discovery. Like IPO, you set the price, but price may trade at higher than the issuance price and lower than the issue. And the same happened with bonds as well, right? You issued a bond at 100 rupees, but suppose market situation is there, low inflation, low recession. In the secondary market, bond may trade at premium at 102, 101. But suppose not a good situation, high inflation, another bond is available with high yield, triple A rated bond, you bought at 6% yield. Same triple A rated bond, same situation, other companies giving 7%, right? So you may switch to that bond. So that price drops. So 100 to 99 may comes, right? Price discovery means demand and supply, right? With high demand, that may push up the price. Low demand or high supply may lower the price as well, right? Sometimes price discovery and valuation may happen in the secondary market, right? Supply and demand, as I told you, or maybe the information, broader market condition. Information means someone like, let's take an example, any broker, like suppose Motilal Oswal, they issued a buy call on the Hyundai, right? Maybe 2200, 2300, they given the price target. So any information, any opinion, any broader market condition, they may help for the company to fluctuate the price, right? For example, if a company performs well, more investor want its stocks, driving the price up in the secondary market. Simple situation, right? The higher price benefits the company indirectly by increasing its market cap and possibly making future primary financing easier. So like suppose this kind of company, if they come up with an FPO and they want to raise debt, they can easily raise money in the future because they have created good credibility in the market. In a summary, any trade of the security isn't first instance, is the secondary market trade. First market trade is the primary market. Famous secondary market include stock exchanges and OTC. OTC for bonds, stock exchanges for stocks. The phrase secondary market can also extend to resale market. You can buy and sell after some time. Right. We quickly discuss this bonds, and we can continue tomorrow. Then let's discuss quickly some of the things about bond, because as a risk manager, you might be dealing with this instrument well, right? Not only on the stocks, but bonds as well, because you may work with banks or maybe with the credit companies or NBFCs in that us assessing the risk of any particular uh, this asset class is very high, right? So before I begin about bond, any quick idea what are the different kinds of bonds? When we bond is a general term, but what are the different types of bonds? Or what are the different types of debt instruments or bonds? What do you think?
Corporate
Angel,
bonds, government bonds,
this is the one type, right?
sovereign bonds.
Sovereign bonds, okay. Gold sovereign bonds,
Convertible bonds,
convertible bonds,
zero
okay.
coupon bonds.
Masala bonds, Aditya told, okay. Then that's investment grade bonds, junk bond, also high yield bonds, right?
Zero
And
coupon bonds,
zero coupon bonds. We'll discuss this.
treasury
Uh,
bonds.
yeah, we'll discuss this once when time permits, right? But yeah, these are the bonds. Bonds you can expect not high return, but yeah, some moderate return over there, right? If it's a corporate bond, you can expect 9 to 15% return in term, and depends on the credit ratings or maybe the financials, where brand value or the company which is issuing. And government bonds that comes with a low default risk, then you can expect some low yield over there, right? But yeah, bonds sometime this people use as the income instruments, right? Suppose you want 9 to 10% coupon or interest, you may invest in bonds comparing to SADS is more volatile. Suppose you don't want to take that high risk, right? Suppose banks or maybe uh, insurance companies, they just want to use their money to investing in for some particular time, 2 to 5 years to match their liability, their deposits. So they invest in that. The bond is a fixed income instrument that represents a loan made by an investor to a borrower. Right? So you are giving a loan. It's kind of you are giving a loan, right? When someone give a loan, like when bank give a loan, what they charge? Interest. You pay interest, and at the end you will also return their principal back, or sometimes with the EMIs you are giving back the principal, right? Bond is also like that. You are giving a loan to the company and they pay you the interest. The only difference is they pay you the principal at the end. Some companies also give the regular principal also with interest, but different kinds of bond work differently. Generally, companies give the different gives back you the principal at the end of the maturity. Suppose there's a 5-year bond. So for the 5 years, they will pay you the interest. Suppose 8%, 10% coupon is there. You will receive 8%, 10% every year as a return, like what you receive in FDs. At the 5 years later, you will receive your principal back. This is the simple bond investment works, right? So there are 2, 3 different terms. Like principal or face value means the amount you invested. Like suppose you invested $1,000 for corporate bonds, that is your principal. Coupon means the interest you get. Suppose annual 5% on $1,000 investment, and you will receive 50 interest per year. This is known as the general in the bond language or bond investment is known as a coupon, right? Coupon can be paid annually, semi-annually. It depends. Generally, it depends how bond is structured, and you will also get this information. Like in FDs, suppose you selected quarterly payment of your interest, half yearly, annually, the same, right? But yields may be different. If they are paying you semi-annually or annually, that differs. Coupon payments is the payment which you give on your coupon. Maturity date. So when fixed income or when the bonds mature and when the issuing company, when they're giving back the principal to the investor, like suppose 5 years. So till the 5 years, they will pay you the interest. Like here, till the 5 years, they will pay you 50, 50, 50, 50, 55 times. And at the end, you will get the $1,000 back. So over the period of 5 years, you will make $250 as is your return on $1,000 investment, right? Generally, in the government bonds, maturity is high. Not only government bonds, even the corporate bond as well. But maturity you can see range from 1 year to 10 years, 20 years, 30 years bond as well. Many times company issue, right? Median terms means 2 to 10 years. Long term means 10+ year, even up to 30 years as well. And short term means a year or less. Generally, the banks issue treasury bills or 7 days to 365 days commercial paper or like this. Issuer, who can be the issuer? Issuer means any government agency, corporates, right? They can be the issuer who is borrowing money, right? Can be government, sovereign bonds, like USDT, UA yields. Municipality means state government as well. Maybe Ahmedabad Municipal Corporation, they can also issue the bond. Maharashtra government can also issue the bond. Indian government can also issue the bond. World Bank can also issue the bonds. So they can, and no barriers in that. The issuer's creditworthiness influence the risk of a bond, right? Government bonds generally come up with the high quality bonds. Government bonds, state government bonds, municipal bonds, they are come up. Central government bonds, RBI, when they issue, they come up with very high quality, low default. So, but you will get less yield as well. But corporations, for them, the yield is high. Yield is the Not exactly featured set in stone above, but an important characteristic. Yield is the yield, means how much return you make, right? Is the effective interest rate earned by an investor if bond is held till maturity, accounting for the purchase price, coupons, and face value at the redemption. Right? Yield will vary inversely with the price. If the bond price goes up, yield goes down, vice versa. Let me discuss this with you one example. I have this. Okay, yield, right? So here, so there are, suppose there is one bond, face value is $100, means you can invest $100. Term to maturity is 5 years. Coupon rate is 5% paid annually. Current price is 105. Right? So someone want to invest, they have to pay 105. But at the end, what you will get 100 because face value is 100. So though you are investing at 105 because bond is trading at premium, right? So though you will get 5, 5, 5, 5 every year, and at the end 5 with your 100 back, right? But your return will be less than 5 because you are investing at higher. Suppose this is same. You are investing at 100 and at the end you will get 100, then your yield to match, your yield would be same as the coupon. So yield means at what price you are investing. Suppose you are investing as the less price. Suppose you are investing at 99. Suppose that's a recession in the market and high inflation and bond is trading at cheap price. Then you may invest at 99. Then your yield might be higher. So return. So you invest at 99, but at the end you will get as a principal 100 back. Right? So investor.
So
Yeah,
one
well,
question. So how did you get current price? Like, did you calculate something to get 105?
no, this is the price I assume like it's prevail in the market. Suppose
The current price. Yeah.
current price. Like suppose when you go and you want to buy the bond and you see the bond is available at 105 or 99,
Okay.
right? So that price you will pay, but the face value is 100. So at the end you will get 100 on whatever the current price prevail, doesn't matter, right? So your yield to maturity depends whether you invest in the bond higher than the face value or lower than the face value. If it is equal than the face value, like 100, then your yield to maturity will be same as the coupon, right? And if it is lower, this higher, right? So sometimes what happens was those who want to invest in bonds, they look for the opportunity to buy a bond with a less than face value so that they can make some extra return. Comparing to 5%, they can at least make something higher than 5%. But in bond investment, you generally not expect too much variability in the return like what we have in stock. But those who invest in millions and billions, for them, getting something extra 0.5, 0.25 is also very high. So this is the simple example of yield. I'll also add this into this file so that you can understand. Right. Okay, I think we are running out of time. So price and other features, let's continue tomorrow. Right. I think we are getting to 6:30. So I'm stopping till here, but we'll continue tomorrow. Anyone has any question, any confusion before we drop today? And
So how can I see this document? Like this is my first lecture today.
okay, so you may go to, this is actually my view, but when you log into this calendar, when you see, let me show you. So when you log into this learner app, you can go to either today's session, right? I'm not clicking on play, but you can click on this today's session and you will find the recording as well as this material as well. I already added like this. Just a second. You can
So
find
there's
attachments.
no. Okay.
You can find the attachments.
And so one
Let
more
me.
question.
Yeah, here the attachment you can go and you can. Yes, you can
Okay,
ask.
that's clear, sir. Sir, I was having one more question. As I'm a science student, I just shifted my field towards finance. So, what advice should you usually give to me? So, like, I'm a beginner. So, like, what should I have to done? What's my roadmap? And like, give a brief intro for that.
I would say like, and yeah, many people they switch their background like from the science or maybe finance or maybe from law to finance and something is that. But yeah, I would say focus more on basic side like what we are covering right now. We are covering some basic things, right? Some terminologies, some things like
Yes,
how
sir.
things works. So focus more on that, right? To get this understanding, you choose FRM course. Maybe you want to build a career into risk management side, right? So you can focus on as a risk manager, which are the areas you should know and uh, how to understand different details like bond side, sets, or maybe different market, bond market, share market, or maybe some statistical terms, right?
Mhm.
Abhishek sent the question like he's a non-math student, how to understand the statistical terms. So it's fine over the period of time you can understand. But to your question, I would say focus on basic more, uh, and
Okay.
you will get over the period of time. As I told you, as I told everyone earlier, it's fine if you don't get everything in one place, but just understand what you have to learn. And over the period of time, when things will be repeated, this will be repeated again and again. So, how you can get benefit from that. So that's my only advice to you, Slok. Right?
Okay, sir. Thank you, sir. Lecture was amazing, sir.
Yeah. Thank you, Slok. Thank you for your feedback. And we'll continue tomorrow. And tomorrow, this again bonds price discovery, how that happened. This we will discuss. And this Excel file I'm not uploading right now. I'll add some more details over here, like example, this expected loss I'll add, this I already added. Yield to maturity bond price, this I'll add. Then this Excel file also you can find in your learners app. Maybe after we finished tomorrow's session, right?
Sorry, one question, sir. The attachment I have opened, and there it is mentioned more of, of definition and what each things mean. So is it more to do? It's not like covering the chapter. Basically, it's letting us know what exactly it means. Correct?
Yeah, this is the pre-read. You can see over here.
Yeah.
Before you begin, what you can learn, what you can know,
Yeah.
general idea. This will come again and again, like VAR. So when in foundation of risk, we will discuss this again. What is expected loss? What is loss given default? What is probability of default? What is VAR? Sometimes the probability of distributions. Normal. This will be repeated again and again. But just to give you some overview, this is kind of an overview and pre-read sessions, right?
Okay.
Yeah. Yeah, Harshita, do you have any question?
So not related to this, but I want to ask: is it fine if I share a WhatsApp group link in the official one?
Even I am not part of that WhatsApp group, Harshita. I think you have to request to. Okay, so you want to be into WhatsApp group? That I think you're asking, right?
No, I'm already in the WhatsApp group already, but we are
Uh,
planning to make one unofficial one too.
okay, you wanted to make an unofficial one. So, you want me to be in that group?
Sir, I didn't know that faculties weren't
Okay, so
in that.
you wanted to create one unofficial group, right? Okay, so that
Yes.
can be done or not. Uh, I I would suggest you can do that if you want to do some informal discussion regarding the study or regarding the market, regarding the investments, thoughts. You can do that, right? That's up to you guys. Uh, I cannot comment on anything, but even I am not part of any WhatsApp group being a trainer. I am just
Okay, sir.
learning. But yeah, you can. It's always a good thing to get in touch with everyone and learn from their experience, and also you can share your experience as well, right? All right, guys. If no further question, I think we are good to drop. Thank you guys for joining and be with me till the end of the sessions. See you tomorrow. Have a great day, guys. Bye.
Thank you.
Thank you.
Yeah. Thank you.
Thank you, sir.